that people who aren't willing to do a lot of work and people who can't stomach the volatility that I can should probably focus on Cameco even more than Kazatomprom, which is in its own way a better company. So I don't own either of Global Atomic or GoVX. The only 10 stock I own is Alphaman, which I've owned for a very long time. Deposits like Meteoric, the rare earth deposit in Brazil, or Centaurus, the sulfide nickel deposit in Brazil. I love things like that. I own a couple copper names that likely violate my own premise. I own Marimaca. I own Hot Chile.
Rick Rule's favorite stock. That is essentially what I want to get to here today, Rick, specifically within the energy transition topic. So uranium, copper, tin, rare earths, whatever. I just want to see what you're interested in right now and also kind of get your high level view on things, because it's been a while since we've talked about energy transition. I think last couple of times we talked about gold and silver and stuff like that, Rick. So obviously, thank you for being here. And for people listening, there are timestamps on your screen right now, because right after Rick, I am going to talk to a uranium production company. And then I'm also going to talk to a copper exploration company being CopperCorp. They have a rather large land package down in Tasmania off the coast of Australia. And then uranium production company, of course, that's UR Energy. So they are producing uranium in Wyoming. So again, obviously, long episode, as it always is. I don't even have to say that, but there are timestamps on your screen right now. There are timestamps in the description, on the time bar. They're everywhere. You can find them, navigate this video however you want. But Rick, again, it hasn't been all that long since you and I last spoke, but I can only really go so long without hearing kind of a fresh quote that changes my worldview in the back of that. And it has been too long, though, since we've done a uranium and a kind of an energy transition metals market overview, if you will. And those markets have changed drastically, even over the last few months. So I want to do that now and in here, starting with uranium. The spot price seems to be stabilizing around the $80 mark after falling from a high of 106 at the beginning of this year. What do you see? Is it building a base to go higher here, or is it taking a break before resuming the downfall?
I mean, the honest answer to that is I don't know. $80, $85 is probably a sufficient price if it becomes reflected fully in the contract market to bring most of the mothballed production in the world back into production. It's probably not a sufficient price, given the inflation that we're experiencing in most markets, to incent greenfield production. A couple things to note about the spot market. The first is it's extremely illiquid. The Sprott Physical Uranium Trust on most days trades a larger dollar volume than the spot market, which means one might say that the Sprott market is the spot market. The tail is wagging the dog, really, truly. The second thing is that what's important in terms of, in particular, the high-quality junior uranium stocks isn't the spot market per se, but the term market. Understanding that is the key to being a uranium equity investor. The term market allows producers or nascent producers to lock in volumes and prices for periods of time as long as 20 years. This revenue certainty isn't present in any other mineral commodity. And the development of a term market in conjunction with the building of new reactor capacity, either large conventional reactors now or small modular reactors in the future, is an important development, because when these reactors are financed to be built, the lenders increasingly are requiring the builders of these reactors to lock in sufficient feedstock to at least amortize the loan. This is really important, Antonio, because a junior who has a deposit which is economic to put in production, but doesn't have the strength on their own balance sheet, used to have to sell. That was their only way out. Now they can sell, but they can also go to Westinghouse, part of Cameco, have the mine built on a turnkey basis for a fixed price, and contract out some portion of 10 or 15 years supply with investment grade counterparties so that they can finance the construction loan against the project. This mechanism doesn't exist in any other commodity that I'm aware of. It will, over 5 years, lower the company's debt cost of capital, facilitate access to debt, and also probably lower their cost of equity capital, because lazy analysts like myself won't need to do commodity price forecasting looking forward. We'll just look at stipulated term contracts. And that's an extremely important change in the uranium market, and a change that most people have completely overlooked. I think the near-term narrative in uranium, the reason that the stocks have done so well for the last 3 weeks, has been the narrative around data centers and the increasing energy use in AI. And I don't minimize that importance. I think it will be very important 10 years from now. I think it also signals a political change, which is useful. And further, it signals that great big energy users value carbon-free generation of power that's uninterruptible at prices much higher than the current electricity price. That's useful. But in terms of impacting the uranium market in the near term, SMRs that are approved today, built 5 years from now, and operational 7 years from now, don't matter much. What matters is the halting of shutting down reactors, the restart of shutdown reactors like 3 Mile Island, and the construction of new reactors around the world, particularly in China. I think it's important that young investors in particular separate the hype around the SMRs, which will be important in a decade, with the reality of the term market and conventional plant construction that's taking place right now. Both are bullish.
But both are bullish, and I understand the bullishness on the long term. I also understand your bullishness when you say reactor life extensions and restarts mattering more over the next 1 to 3 years. But what about before that? What needs to happen for the spot price to go up from here on? Like, do we need to see spot going back heavily into the market? Is it something else? What do you think?
That would help, but what matters more is the change of Japanese inventory from held to sale to inventory for fuel. Nobody knows how much the Japanese still have, but we know until a year ago that they weren't consuming any of it. And the fact that you saw Itochu on the sell side in the spot market day after day after day after day after day suggests that a Japanese trading house couldn't possibly have had that much inventory that they were selling on behalf of Japanese utilities. That supply's dried up. And that's very important. The more reactor restarts that you get in Japan, the less the uranium market is pressured by Japanese inventories, which was probably the most important bearish factor in the uranium market for the last 5 years.
When do you think that's going to matter? Is it 6 months, 3 months, a year?
For the spot market, I don't know. And to be honest with you, I think the spot market is important for psychological purposes, for narrative purposes, but it's nowhere near as important as the ability of the Kazatomproms and the Camecos and the lesser lights to lock in prices and volumes for 10 years. Uranium will be, well, not will be, is the first commodity where the producers are free of the tyranny of overnight markets, where irrespective of what happens to the spot market, they are guaranteed prices and volumes in the term market. This is critically important to have a sense, if you're producing 5 million pounds a year as an example, the 3 million pounds are contracted for out 5 years, with prices beginning at $75, ratcheting up with inflation, so that you know that 10 years from now, you're getting 110 or 115 bucks a pound. If you understand something about your producing margin and you understand something about the amortization of the capital involved in building the mine, you can do net present value calculations in uranium that are an order of magnitude more accurate than they would be for any other commodity on the planet. And that's hugely important.
It is precisely that, in combination with their lack of ability to quickly ramp up production, that I think makes for higher premiums on the uranium stocks, and specifically the very few producers that we do have. But Rick, if this was the first time you had heard about the growth possibility in uranium and nuclear at this stage, well, I don't know, you're seeing, big tech going nuclear, and let's say you see that happening, you hear about it on CNBC or something like that, you find this opportunity, would you still go as heavy on it as you did back in 2018?
It'd take me 6 months of study, which I don't have to do because I've been studying it for 20 years. But when I look, as an example, at rough net present value calculations around Cameco, they're taking place at numbers like $65 a pound. If Cameco is able to lock in $80 floors with escalators, that revalues Cameco. And in addition to that, it increases the number of pounds that they're willing to produce. You'll recall from earlier interviews, Antonio, and probably from your own work, that Cameco has said that they're not going to shut down projects into production until they've signed sufficient term contracts that they can earn reliable return on capital employed for their shareholders. As an example, with regards to their U.S. in situ production, they haven't returned that to production, despite the fact that the spot market offers them sufficient incentive. What they've told the market, including the utilities, the buyers, is that until they have locked in sufficient term prices and volumes that they guarantee their shareholders an acceptable return on capital employed, they're not going to return that stuff to production. So a couple things happen with these term markets. One, it increases the certainty, but it also allows what would otherwise be marginal material to be produced and produced profitably.
How'd you get exposure to the sector at this stage of the market, though, at this stage of the cycle, if you will? I mean, Cameco seems to have been the obvious choice if you go back a few years, but is it time to start going down the quality trail from here on out?
Depends on how much work you want to do. I have learned, to my regret as I age, that most people would probably be better off buying market beta. Beta defined as the outperformance of the best producers in the sector relative to the broad market, which suggests that people who aren't willing to do a lot of work and people who can't stomach the volatility that I can should probably focus on Cameco, even more than Kazatomprom, which is in its own way a better company, but exposes you to political and operating risk inside their own corporate wrapper. For people who are willing to do work, for people who are willing to read feasibility studies, for people who are willing to do detective work around contracts, because not all companies disclose their contracts, there's certainly more opportunity than juniors because people aren't doing the work. When I look at some of the research reports published by the sell side around things like Paladin and Lotus, I'm astonished by the shallowness of the research. I'm astonished by the sell side researchers' focus on narrative as opposed to arithmetic. And the idea that a diligent young non-specialist named, let's say, Antonio, as an example, in Belgium, can outcompete a published analyst in Canada who doesn't show up to do the work is, I think, a special opportunity.
That's a good dream to have. It gives me something to hope for. But when you ask how much work you want to do, if people are like myself and don't like doing any work and simultaneously don't like themselves, maybe they should consider going into the early stage exploration stories out there. And Rick, I'm stealing this question from Bill from MSC, from Mining Stock Education. So people go watch his video with Rick on gold stocks. But if you could only buy one uranium stock right now, which one would it be?
For most people, it would be Cameco. For me, until the takeover, it would have been Fission. It was pretty obvious that Fission had to be consolidated. I had hoped it would be the next gen that did the consolidation, but it wasn't. That's okay. But for most people, it's Cameco. Cameco has rock that they treat as waste that other people would call resource. Your risk in Cameco really is that they are venturing into businesses that they may or may not understand. Their buying of Westinghouse means that they've gone from being a full cycle miner to being an EPCM contractor. If they pull it off, it's fantastic. It means that they've gone from being a producer selling uranium to selling watts. It remains to be seen if they can pull it off. There is, I think, an argument for people who aren't willing to do the work but can afford real risk and can stomach volatility to buy the ETF. I don't own it because there's too many crummy companies in the ETF. But the truth is, if the sector does as well as I think it will over the next 5 years, you can afford suboptimal speculation, the type of suboptimal exposure that you get in an ETF without having to do any work whatsoever. Buying the whole sector when the whole sector works, probably not a bad idea. Understand that, and you've seen this, Antonio, since you've been podcasting. This sector can give you 15% moves up or down, the same way most people inhale and exhale. They can do it for no reason. A big institutional investor may get some redemptions and have to sell into a market where there aren't sufficient bids. It has nothing to do with the companies. It has everything to do with the flow of funds that week to a big institutional investor. And people who hold these stocks, whose interpretation of the value is set by the market, will inevitably get whipsawed. They'll inevitably panic and sell out on a 15% downtick, and they'll get elated on a 15% uptick because the numbers justify the narrative. It's important for people who play the game themselves to have their own interpretation of value and to have the ability to stomach this sort of volatility. It's information and knowledge that gives you the ability to stomach volatility. Nothing else that I know of, other than not looking at the screen, will do that.
Taking risks is something I also want to touch upon later on, but you just mentioned the ETFs, and this question might result in a predictable answer given you're a large shareholder of Sprott Inc. But URNM, URNG, URA, what ETF do you like?
I think the Sprott product is the best. Primarily because URA is all things nuclear related. It isn't particularly a mining index as opposed to an industry index. And in a rock and roll bull market, which we may have, I think the uranium producers will do better than the uranium consumers. In other words, you wouldn't necessarily want to have uranium burning utilities or service companies in your portfolio. It is worthy to note, though, that I am, I think, probably still the largest shareholder in Sprott and an indirect beneficiary in the management fees that come from the Sprott ETFs. I was, during my duration at Sprott, part of creating those products, and I'm justifiably proud of the factors-based construction of those products.
Would you still make physical part of that portfolio? Again, we're kind of in the hypothetical realm of what if you had just found out about this space? Would physical still be a significant part of your portfolio?
I still own Sprott because I think that demand for uranium is going to grow enough that the spot price has to go up to accommodate supply. I think that $80 or $85 is sufficient incentive to restart the existing mothballed products. So for the next 2 years, the spot price doesn't have to go up, but I think it will go up. I think we're seeing a circumstance with the extraordinarily low volumes that trade on the spot market. We're seeing some evidence that the inventories that make up the spot market are getting stretched thin. I don't know that to be true, but I do know that my former employer in Sput has taken, what, 60 million pounds and put them in supply heaven. And I know that every time a major reactor gets built anywhere in the world now, the lenders are requiring the builder of the plant to lock in supply. And when you look at the relative illiquidity of supplies on the spot market, and the increasing, if you will, diversion from spot inventory to term inventory, even on the traders' balance sheets, then I think you have the probability in place that the term market pulls the spot market higher. I need to say, I have sold more than half my position in spot because I bought it for just exactly this move. I thought that the uranium price had to clear from 20 or 30 bucks to some number like 70 or 75. When that happened, my investment thesis was realized. And given that I had bought that position for precisely this trade, I took a lot of money off the table.
What about if we raised the risk tolerance on here again? As you said, for most people, it would be Cameco, the only one stock you'd buy. What if I capped you at $100 million market cap? What company would you go and buy then?
I'd probably look at either Paladin, which I think is the company best suited to putting new projects in production with term market financing, or I'd hold my nose over GNA and buy NextGen, which is the best undeveloped uranium project in the world. There's a lot to be said for quality.
Yeah.
If you're trying to, tempt me down into the penny dreadful names, I don't need to do that. It's important to note that the exploration stocks will benefit perhaps from narrative, or perhaps they'll get lucky. But I point out to exploration speculators, and by the way, I've been one for 50 years, that if the price of something that you don't have any of goes up, it doesn't have any intrinsic value to you. And most of the uranium exploration companies are exploring for, rather than enjoying inventories of uranium. If you look at these exploration companies agnostically, that is to say, you look at their deposit and you think of it in purely economic terms, stripped of the uranium narrative. And if there are technical reasons to believe that there's a discovery on offer, that's a different question. You can be attracted to them. Most of the speculators that I come into contact with, as a consequence, as an example of ranking their portfolios, conflate the valuations of uranium juniors who don't have any uranium with the increase in the price of uranium itself, or companies that do have some. And that's a mistake. You have either to confine yourself to the technical aspects of their exploration effort, or you have to be a very skilled narrative trader. You have to understand the impact of a story on an uninformed market. That's a time-honored speculative technique. My old friend Bob Bishop was a journalist, and he was superb at understanding the impact of a story, whether true or not, on a well-prepared market. Antonio, I'm not that. You've seen me. I can't even dress myself. I don't own a TV. My ability to understand the impact of a narrative on a market, particularly an uninformed market, is very low. So I'm the wrong guy to attempt to do that.
I think you've started dressing yourself well since you started wearing the battle bank shirt, which you're wearing right now, I suppose.
That's a uniform. That's a uniform, of course, and anybody could wear a uniform.
But most of the speculators I come into contact with as a consequence of me posting memes on Twitter seem to have some kind of a hope that their penny dreadful is going to get taken out during an M&A feeding frenzy. Is that in the books for uranium? Like, do some of the producers even need to buy the juniors at this stage?
If the junior makes a viable discovery, but that's an if. That's why I say that you have to look at things from an empirical viewpoint rather than a narrative viewpoint to enjoy M&A. Why would somebody take over moose pasture? Why would somebody take over what's in effect a work liability, unless that land were proven with the third dimension, the drill bit, to be prospective. There are penny dreadfuls like Canalaska, which have worked 2 decades to be overnight successes, and now have the third dimension expressed by a drill hole. Those aren't the companies that I'm trying to insult. The companies I'm trying to insult are companies that failed in gold, and they failed at crypto, and they failed at pot, and now they stake some, moose pasture in Saskatchewan or somewhere else, add uranium as a header on the share certificate, but don't really have any uranium. While those stocks can do okay in the very near term, you need to understand that this isn't, well, I guess it's a speculative activity in the sense that GameStop and things like that were speculative activities, but they're speculative activities that aren't geared in empirical work.
Is there a uranium stock that you currently have rated at 4 or better, irrespective of the size of the market cap?
I have Cameco, NextGen, Paladin, and Lotus, all as 4s.
Oh, wow. What, anything lower than that? A 3, a 2?
No.
Is there a stock you currently have? It doesn't matter whatever industry they're in. Is there something you have rated as a 1 or a 2?
No.
Nothing?
There are several North American natural gas stocks that are flirting with 3s. But nothing that is of particular interest to the speculative crowd.
So essentially, NextGen, Paladin, Cameco, those are the highest rated stocks you currently have.
Lotus, yes.
Lotus, that's right. Yeah. Well, you often say that you rather take political risk over technical risk. Are you being greedy when others are fearful on Niger?
I like to understand my political risk. And in Niger, the nature of the political and sociological risk is so new that I can't take that risk. So I don't own either of Global Atomic or GoVX. I need more experience with the new political reality of the Niger Basin, with particular regards to Niger. I know that Mr. Roman is very far along in his discussions with officials in Niger, and I know that he's very far along in discussions with lenders. If the lenders can put in place a credit facility that includes political risk insurance from the IMF, that'll go a long way to convince me to pay up for Global Atomic. But I don't have enough information about the nature of that risk to do a risk assessment of the sort that would allow me to take that risk. In other words, I like quantifiable risk.
Wouldn't the contrarian bet here be, selling out of your Cameco position and going long Global Atomic? Because Cameco's up 45% on a 1-year chart. Global Atomic's down 45%.
Yep. If people are comfortable making a numerical bet without understanding the inputs, in other words, if it's really a bet as opposed to a speculation, maybe not a bad bet. You aren't betting on uranium then. If you're betting on uranium, you're betting on the guy who actually has access to his or her reserves, which is Cameco. If you are taking the other bet, you aren't betting on uranium. You're betting on the outcome of a political situation in Niger, which I don't have enough information about to calculate the odds correctly.
But these risky plays overall that we're talking about, right? Things seem to often go wrong in this segment of the market where it's lower market cap and a challenging jurisdiction, and especially the combination thereof. And while I know that you can afford to lose infinitely more money than my entire net worth, how should I deal with those risks? Is it position sizing that I have to pay attention to? Is it something else? How do I deal with it?
Probably yes and yes. if you are able to take a portfolio of political risks, that helps.
Hmm.
As an example, my my political risk in the middle part of the 1990s, when nobody wanted to be in Africa, was really Pan-African. So I was taking risks in Mali, Burkina Faso, which I considered low risk, Eritrea, which was high risk, South Sudan, which was insane risk, and Congo, which was whatever worse than insane is. But the fact that I was investing across 7 or 8 jurisdictions meant that if I got really badly hurt in any one jurisdiction, it wouldn't impact portfolio performance. In the middle part of the decade of the 1990s, nobody wanted to invest in Africa, and I could invest in consistently tier one projects, and I knew that any one success would amortize a lot of failure. As it turned out, the three biggest risks I took, really, 2 in Congo and 1 in South Sudan, and 1 in Eritrea for that matter, all worked. If you had asked me in 1994 what the probability of all of them working was, I would have said 0.
Hmm.
But the truth is, that's not the way it worked out. Now, in fact, with a couple of those risks, South Sudan and Congo, I did an awful lot of work. I mean, an awful lot of work. Talking to the World Bank, talking to the IFC, talking to the U.S. State Department. I did a lot of work, and I did a lot of work with those few white guys who were left in Congo, in country hands.
Hmm.
So they were pretty informed risks. The risk that we're facing in Niger is of a type where I don't currently have the ability to understand all of it. I looked at Congo for 4 years before I committed heavily. And that's why I say if the IFC is willing to provide political risk insurance on the construction facility that Global Atomic is looking for, that'll tell me a lot.
Hmm. Well, on the topic of asking questions in 1994, I don't think I would have been able to do that because I don't think my parents knew each other at the time. What about
That hurts.
is there is there a jurisdiction now where you, again, going back to the whole, I want to take jurisdictional risk over technical risk if I understand the jurisdictional risk. Is there a jurisdiction right now where it is worth taking the jurisdictional risk because they have the good rocks?
I think if you're not American, Russia is probably such a jurisdiction. The Russian stocks are insanely cheap. And I think eventually this dispute between Russia and a lot of the rest of the world, I hope anyway, it diffuses. The rock packages, and also, by the way, the management teams in some of these companies are insanely attractive. And for people who can risk 100% of their money, who aren't American, I think there's very good opportunities there.
Hmm.
I see the Democratic Republic of the Congo continuing to improve. I see Angola improving. I think politically, both Burkina Faso and Mali will improve, although I see the current regimes in both places playing Russians against the West, trying to extort better terms from the mining companies. All the while, investors like myself getting reassuring noises from the powers that be. Yeah, I'll leave it there. I think if we saw the overt resumption of a civil war in Myanmar, that there might be opportunities in Myanmar, either in the silver space in the far north or in the rare earth or tin space. I also think, and most of that information isn't going to be of any use to your listeners because they won't want to avail themselves of gaming opportunities in that fashion. Argentina seems to be trying to improve. And there's immense oil and gas reserves in the Vaca Muerte, immense exploration potential for copper, gold porphyries in the Andes, and immense possibilities for gold, silver exploration in the Massif in southern Argentina. So I think that bears looking at. Probably the risks in Brazil with Lula are overstated. Certainly, I'm seeing superb discoveries being made there. And I'm seeing discoveries in the nickel and rare earth and platinum space being priced dramatically lower than they would be priced in other jurisdictions. But the piece that's probably of the most use to your listeners would be Canadian natural gas. I think there's a 50% possibility that the Prime Minister of Canada will be thanked and excused in the next election. And if that happens, I think a basket of Canadian natural gas stocks would immediately double. I think even if the Prime Minister isn't thanked and excused, that the difficulties in front of the Canadian economy and the revenue projections of the Government of Canada means that the Prime Minister and his party will have to be more receptive to the business case for Canadian natural gas exports. And so if I had to pick a place where I thought that improving politics would impact share prices, it would have to be on a basket of Canadian natural gas stocks.
It's interesting you mentioned Russian stocks again, though, Rick, because I think you told me about them, 2 years ago or something along those lines. And I know you had some exposure to them, which hasn't been fun in the meantime. How do you even measure anything along those lines? Like, they're cheap. I get that part. But them being cheap doesn't mean they're not going to get cheaper, or they're not going to get stolen by your broker or government or whatever else.
I think certainly if you're American, you can't do it. It's a no-go place. The United States government will continue to steal Russian assets. We've stolen $300 billion of their treasury so far. And the Russians will retaliate. They will steal the assets of U.S. investors in Russia. They will do that. Maybe not individual investors, but they certainly will do that. So the caveat, first of all, is that you have to be either a non-U.S. person or you have to be an extremely circumspect U.S. person. I don't qualify there. But if you had access to an account in Singapore or an account in Dubai or an account in Austria or Switzerland, that's an entirely different circumstance. There are companies like Norilsk and Polymetal and that very, very high quality mining companies with absolutely top tier assets that, if there is more of a normalization of Russia's relationship with the West, that will reprice back to being merely undervalued rather than stupidly undervalued. But that's a risk you take. My suspicion is that European speculators might have better access to information about the potential normalization of relationships between, as an example, NATO and Russia than I would. And certainly they're some of the only investors on the planet which would have access to the facilities that would allow them to participate.
Yeah, I don't have much to add there or ask. I was just curious about how this works, because I used to like Russian stocks too, because superb, management teams and cheap and yada yada yada, and then everything went to where it.
I had 22 really good years in Russia, and so when I look back at what I lost, it's very painful. When I look at what I lost compared to what I made, I have uh, no cause for complaint.
Hmm. What what about if we go to tin from here? Because you mentioned tin for a second. Would you be looking to get exposure at this stage of the market? And when I say get exposure, I really only know four tin companies that could provide you that exposure. So tin, yes or no? But also, how do you get exposure to it?
The only tin stock I own is Alphaman, which I've owned for a very long time.
Hmm.
It exposes you to both political and social risk. Congo's a rough place, and North Kivu, where Alphaman is a rough place within a rough place. It's also easily the highest quality tin deposit on the planet. Big grade, big production, huge margins, exploration upside, and big risk.
Hmm.
Uh, a truck of tin concentrate moving off the Bisay mine to the Ugandan border has between $400,000 and $500,000 worth of tin concentrate on it, where people will kill each other for $100. Um, uh, so far, so good, but lots could go wrong.
Why not any of the other ones? I mean, would you have MLX? There's Cornish. There's well, again, a couple of other names, and then there's Myanmar.
Cornish size, I mean, nice little deposit, politically secure, but well, we've talked about small mines before. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. So I want, if I'm taking the risk associated with exploration, with development, with production, I want this. I want the opportunity for outsized returns. I want, at a minimum, in situ recoverable uh, reserves and resources, at least the target size, to exceed 2.5 billion US dollars. I want prospective. I want my deposit to be in the best cost quartile worldwide for its commodity. And I want the return on capital employed to be in the best cost quartile for the commodity worldwide, but at least 25%. And I have a difficult time in the tin space finding somebody who meets those criterion other than Alphaman and the companies that are on its coattails exploring the same trend in Kivu. Those are much higher risk, of course, because you have to look at those resistive anomalies, those ridges, and drill them, and then you have to repeat whatever Alphaman has done, unless Alphaman is willing to share infrastructure with you.
Might I interest you in a rutile deposit in Malawi? I was at a conference this summer. I'm not going to name the
Absolutely.
name, but I met a company there that did get my attention.
Now, listen, those big deposits, particularly when they're out of favor, I love. I mean, I just love. You'll recall our discussions about uranium when you first were a podcast host. The fact that people hate something is the best possible advertisement for me. People hate Malawi. Most people can't spell rutile, never mind know what it's used for. They think that graphite is a component of pencil lead. Uh, Deposits like that, deposits like Meteoric, the rare earth deposit in Brazil, or Centaurus, the sulfide nickel deposit in Brazil. I love things like that. I love established deposits that are clearly tier one deposits that are out of favor with the price going down, where the market says, why bother? Nothing's going to happen for 5 years. I've learned at 71 years of age, Antonio, uh, that 5 years isn't such a long time, particularly if that 5 years comes with a 10 bagger wrapper. If I can deploy a lot of money in a deposit where I have no deposit risk, where I have market risk, a lot of money in a commodity that's priced on a global basis at a discount to the total cost of producing it in terms of the cost of capital, so that the commodity price has to go up. I just don't know when. That's been so good to me. Uh, so good to me. I can't help myself.
Do we have that commodity now, though? Is there something out there besides natural gas that's hated and that's below the cost of production?
Yeah, I think rare earths. I think the reason why the rare earth production cost is so low is because the Chinese have been willing to use extractive technologies, basically spraying sulfuric acid on the ground, that are unacceptable even to the Chinese.
Hmm.
And I think if you normalize production costs, which the Chinese are starting to do, to take into account environmental degradation, that the costs associated with rare earths on a global basis are going to increase by 35 or 40%. The utility of rare earths is already established. People pay what they have to pay. If they can get it cheaply, they'll do it. The Chinese certainly have increased production to lower the cost of rare earths to discourage production in other parts of the world. But I don't think that continues. I don't think the rutile prices or the graphite prices have to go up. But in the case of Sovereign, the company will clearly be in the lowest cost quartile worldwide. Now, I don't think I'm going to get a 10 bagger out of Sovereign because I think that Rio's going to scoop them up. They're going to slurp them up with the same outcome in mind that I have, you know. But that's okay if I get a 30 or 40% premium from here. Well, I would prefer a 10 bagger. You know, I've had worse outcomes, certainly.
I did a deep dive interview with Frank Eager of Sovereign Metals on the back of the conference, on the back of your conference in July. So it must have been in August or whatever. So I'm trying to link it up somewhere. It was a very good conversation. But for rare earths, where do you go for exposure? Again, not easy to get exposure to rare earths.
There was another company at the conference that I'm interested in, Aclara,
Right.
Meteoric. I mean, the ionic clay style deposits where nature did some of the metallurgy for you seem to be in economic concentration, easier to discover in Brazil, I guess because of the weathering profile in those big calderas than other parts of the world. The other extraction technologies around rare earths probably are viable, but I understand them less well. So, because of my own knowledge limitations, I'm afraid to approach other mineralization styles.
That's fair.
I think I think the fault is probably mine, as opposed to either the fault of the technology or the fault of the market. I'm prepared to concede that, but I have to operate within my own limitations.
I sincerely believe that there is a geological edge to be had in this market because I find that fewer and fewer people care about learning about different geologies and metallurgies and different project styles and so on. Rick, we're talking about, and I know we almost have to go here, but just one last thing. We're talking about energy transition, essentially, is what we've been talking about so far. We can't really do that without talking about copper. And copper is in this kind of interesting spot where, Dr. Copper, but the economy is going to be bad, supposedly, and it's already at $4, higher than $4. So what do you make of copper at this juncture?
I love it. I'm not an economist, so I can't tell you if we're going to have a recession or depression. I mean, I don't know that. But what I do know is that on a global basis, utilization of copper is increasing, and we've underinvested in copper for 30 years. So developable projects are more and more and more scarce. 30 years ago, the average mine grade for copper worldwide was 1.5%. Today, the average mine grade is less than 0.5%. So if you're looking at copper the way you must, which is as a multi-decade investment, not a 3-month trade, you look for deposits that are large enough to make a difference, where a major has to own them. And if they have to, they will. You look for deposits that at today's copper prices would be in the bottom quartile in terms of the global cost curve, and where their returns on capital employed would be in the best part of the cost curve. The same rules apply, irrespective of commodity. Size matters, profitability matters, return on capital employed matters, winning the last man standing contest matters, management matters. I wouldn't look at copper so much as a subject as I would a theme to evaluate the economic projects of individual companies in the space. Certainly, I own a couple copper names that likely violate my own premise. I own Marimaca. I own Hot Chile because I like the coastal copper belt in Chile. I like the accessibility of shipment. I like the infrastructure. I like the known metallurgy. I like the jurisdiction, although it's getting worse. I don't see either of those projects without a high-grade starter pit meeting my return on capital employed targets. But they're both large enough copper deposits that my hope is, with additional drilling, that they'll discover those high-grade starters and then bring the ROCE number up over 25%. I also own the Lundin vehicles at Vicuña, simply because I see it as the most profound copper discovery in the world, after Kamoa-Kakula, probably, since Escondido or Grasberg. I have no idea ultimately what the economics are going to be, but it's a truly stunning accumulation of copper and gold, and it's operated by very smart, very honest people.
Well, to toot my own horn, once again, I also did a deep dive with Marimaca Copper in the back of your conference, but you have to go in literally 1 minute. So what else do you have going on right now? Anything you want to tell me about before we leave it off?
Nothing other than I appreciate the growth of your channel, which I think is a testimony to your hard work over the last 3 years. It's been a wonderful progression. I'm delighted to see you having done that. And I, as always, invite your listeners, if they like what I have to say about natural resource investing, to personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, and for no obligation, no charge, I will personally rank them. Please no pot stocks, please no tech stocks, please no crypto. Ruleinvestmentmedia.com, natural resource stocks only. And I have to jump off right now. I have another call in 1 minute that I have to be smart on. Okay?
That is understandable. Talking to me is not necessarily going to help you be smart for that call. Might even have the opposite effect. So I'll let you drop off now. Thank you so much for doing this, Rick. Looking forward to our next conversation in about a month or something like that. But I have a long trip to make all the way to Wyoming. Actually, not that long, not that far away from where you're at, Rick. But then I'm going to Tasmania, which is going to be a long trip for because I'm going to be grilling 2 CEOs in this week's CEO barbecue segment. But of course, not before my favorite part of every episode, and that is, of course, the disclaimer. And then it's a CEO barbecue. I promise, but there's a warning on your screen right now. That's not there just for the jokes. You're obligated to read it, but you're also better off actually reading it and understanding what it says, because this is not just some disclaimer. It is an actual warning that will potentially help you not lose money, which, by the way, is the norm and should be the expectation in this sector. Money is part of it too. I'm here to make money. This YouTube channel is a business that provides content creation services, typically to the companies that you're going to see featured in here, right? So in this episode, specifically, both companies, Your Energy and CopperCorp, have paid for the production of their interviews. So you should look at their interviews as marketing. They're likely seeing their participation in this program as a chance to do some marketing. Start by understanding that this is marketing, but also most company communication, I want to say all company communications online, albeit this interview, their presentation, their Twitter account, or everything else, those are marketing tools. And although I don't make buy or sell recommendations, because first of all, I have no idea what I'm doing, but mainly because there's a clear conflict of interest. And although I don't do it, many out there will. And you should be aware of that inherent bias. That bias is not always going to be clearly disclosed with everyone out there. There's a lot of people getting paid by companies and not disclosing it properly. So It is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and just treat it as marketing. Don't rely on it. This is not research. The things that, even if there's a great Twitter account that you love and you think they put out the best research possible, just treat it as marketing, because it is highly likely that it is. Unfortunately, though, none of us are magicians. I'm definitely not a magician. At least that's one thing I know for sure. The guests here are not psychics. The CEOs are not psychics either. They're not magicians. So we don't possess any superior knowledge about what's going to go up, what's going to go down, or what's going to go in circus, or what's not going to go anywhere. So unfortunately, try as I may, I am not perfect. I call this show the CEO barbecue because it is meant to grill the CEO. I try to ask the questions that no one else out there is asking. But that doesn't mean I'm going to catch all red flags or all challenges with the companies or all shenanigans, whatever it might be. And again, although you shouldn't tell my wife this, I'm not flawless. Matter of fact, again, I still have no idea what I'm doing, and I've only had facial hair for a couple of years, which is to say I lack experience. And this is really all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. If you don't understand it, don't do it. In addition, no guarantees are going to be made besides one, and that is the forward-looking statements one. There are going to be forward-looking statements in these conversations that I'm about to have with UR Energy and CopperCorp, and they are conversations that are general and impersonal in nature, containing hopes for future events that may or may not take place, depending on many different factors, both within and outside of companies' control. Be aware of that. Be aware of the inherent risks of investing. Be aware of the online bias. And please talk to someone who's proven to know what they're doing and talking about, like a professional investment advisor, as well as do more research. When I say research, I don't mean YouTube videos and Twitter accounts. You go to setterplus.ca. That's where you do research. That's where you're going to find the company's official filings. And if you don't do that, you're highly likely to lose your money. There are disclaimers on your screen right now. Again, if you don't enjoy losing money, read them, try to understand them, be careful out there. With all that said, though, I will actually kick off the CEO barbecue portion of this Energy Transition Talks episode by going to Wyoming in the US to talk to John Cash and get an update on an in situ uranium production facility, which is, of course, operated by UR Energy. I've done numerous interviews with John over the years, so I'll save you the 10-minute company overview here. But just very briefly for newcomers, UR Energy, as I mentioned, is a currently producing uranium mining company that operates the Lost Creek ISR production facility in Wyoming, specifically South Central Wyoming, that is. And Lost Creek is currently awaiting the remaining approvals for expansion, as well as they have all the major permits and authorizations that allow them to begin construction at Shirley Basin, which is their second ISR facility that they have, also located in the state of Wyoming, so also in the US. And it's expected to be sending out drums of yellow cake essentially in late 2025, so late next year. UR Energy trades on the New York Stock Exchange under the ticker symbol URG, as well as in Toronto on the Toronto main board as URE, where an average of about 90,000 shares trades each day, and where I can also see a 52-week high of $2.72 and a 52-week low of $1.46 Canadian, that is, with about 363 million shares outstanding and the 630 million, again, Canadian dollars market cap. Today, URE is a $1.73 stock. With all that covered, a lot has happened since you and I last spoke, John. So, of course, thank you for being here, first of all. I am looking forward to this update, though, and I want to kick it off by addressing the elephant in the room first, at least one of the two elephants, really. It's a big room, apparently. But the capital raise you did this summer, I thought the expectation with the market seemed to be that you had enough money to get to free cash flow without having to raise capital anymore. What happened? Why raise capital now?
Yeah, no, and thank you for having me on the show again. It's good to catch up again, Antonio, give an update to your audience on what we're doing at UR Energy. But no, completely fair and good question about why did we do the equity raise when we did. And for those who did a deep dive into the paperwork that we filed along with that raise, you'll see that one of the potential uses of funds was M&A. And that was our primary reason for going out and doing the raise, is looking at M&A opportunities. And obviously, I can't speak specifically about what those opportunities are, but for those who are dialed into the industry, you know what assets were available around that time. So you can make assumptions on what we were doing. But So we have not utilized those funds for M&A. One of the opportunities that we were looking at did not come to bear for us, unfortunately. But we felt like we did what we needed to do for a project that we felt would be accretive, but we were not able to prevail on that. Another party did. So having said that, we'll continue to hold those funds for now. We have a lot of other potential uses for them, and I know we'll probably talk more about exploration a little bit later on in the conversation, but right now we are extremely well cashed up. The last quarterly report that we put out with public numbers, we had a little over $120 million in cash with no debt, and we're continuing to ramp up production at Lost Creek and building out Shirley Basin. So we've got a good, strong cash position that's going to see us through for a very long time. We are bringing in revenues now. For those of you who are familiar with the story, we've got a contract book this year of 570,000 pounds. So we've been delivering into that with revenue coming in. We still have deliveries through the end of this year, significant quantities. And so, we'll hold those funds for now. Disappointing that we weren't able to utilize those for M&A, but we're going to continue to look for M&A opportunities going forward, and we'll see what happens. We're pretty careful when it comes to M&A about what we pick up. It has to be truly accretive to our story, and it has to be something we can put into production in the foreseeable future with reasonable economics. We've never been a company to go out and make acquisition to just talk about pounds in the ground. We're a company that prefers to talk about pounds in the can.
That's a very well said right there. And thank you for the explanation. I did wonder about the timing. Of course, hindsight is 2020. You could not have known that the stock is going to go up on the back of that. But it seems like it was just a timely matter. You had to get the capital. You thought it was going to be creative. Didn't work out. Happens. I do want to talk about potential future M&A, though, once we get to that. But did the race have anything to do with the fact that the production ramp up is going slower than you had initially thought, or something else that you thought, I could use a little bit extra cash to do whatever, something to do with the production profile?
No, really, that was not in the back of our minds at all. Really was dedicated more to M&A efforts. Now, we did cast a pretty broad net when we talk about use of funds, because you never know how M&A is going to go. So you do need to kind of lay the path forward for what other potential uses of those funds could be. But no, if using that for other ramp-up needs or acquisition of pounds was not a part of the equation or thought process at the time.
Why I'm asking this is because of course, labor challenges. I mean, you've told me in previous interviews that your biggest challenge right now is indeed finding and retaining talent. How do you solve that, though, objectively? Where do you go? What do you do? Because it doesn't look like an issue that you can just solve by throwing money at it. Like, it seems like it's going to take more thought, time, and effort. So how do you solve it?
Yeah, there's no silver bullet. Believe me, we have agonized over this for many months now of how do we attract the best people? How do we retain the best people? Those are two fully separate issues. We've looked at pay raises, bonuses, things like that. We have been working on implementing some different pay structures. So that's in progress. Just trying to make the safest work environment we possibly can, developing relationships with our employees, and just being a good, solid employer with good benefits is how we intend to attract people and retain people going forward. So it's not easy. The unemployment rate in Wyoming is still incredibly low. So if someone wants to leave us and go get another job, I mean, they can quit on Friday, and by Friday of the next week, they'll probably have 2 or 3 job offers. So it's difficult to compete in a market like that. And the mine site at Lost Creek is fairly remote. When people leave us, we'll do an exit interview. And typically one of the leading causes that people leave us for is it's too remote. They say, we don't want to drive that every day. I get it. I wish I could move the mine closer to town, but that's obviously not an option. So something we got to continue to work on. We are making progress. Retention rates are improving through time. Our team is getting more and more skilled. They're requiring less and less oversight to do their job in an efficient manner. And so, yeah, things are headed in the right direction. But as a CEO, of course, they're never as fast as I want them to be, but we are making progress.
Well, how fast is it? How long is it going to take you to employ and train enough staff in order to get to your licensed production capacity here at Lost Creek?
So we have all of our people. I mean, we still struggle a little bit with turnover, but on the average day, we have all of our people. Maybe we're missing 2 or 3 or 4, but by and large, we have our people. So it's more of a turnover matter that we have to address now, making sure that we stay staffed up. So that's where our focus right now is, more a little bit less on hiring and more focus on retention and keeping people trained up and getting those efficiencies built in. So we're getting there. It's hard to predict how long it'll take before we get up to nameplate production. We'd love to be there early next year, but we'll have to see where manpower goes, where our retention goes, and how the mine performs. But certainly that's our objective, is early next year to be producing the quantities that we need to be able to fill our contract book.
You mentioned pay structures there, and that you are potentially going to have to offer more money. Are those higher paychecks going to result in any substantial increase in your cost of production, or how do you see that?
So drilling is our number 1 cost. Manpower is probably number 2. So if we, and I don't want to use numbers here, but if we throw out a certain percentage increase in wage, that's only a certain percentage of the overall cost. So will it affect cost? Yes. Will it have a material impact? Not likely, but we'll reserve judgment on that and as things evolve.
Well, you did communicate. So where I'm going with this, of course, is talking about it in the concept of the capital raise as well. But you communicated that so far you don't foresee having to breach your supply contracts because of this labor issue. No. But how much of a margin is there now? Like, how much more room for delays or challenges is there before you do have to breach your contracts, essentially?
Breach of contract is not even in our discussions, period. So we're going to fill those contracts with production. If production can't get there, there are a number of other mechanisms to get pounds, and we'll explore those. And we've got a very sophisticated senior staff. We've got very strong advisors to the company. We know the markets. We know all the players. And even the utilities, if we struggle to produce and fill contracts on a timely basis, we can actually go out to the utilities and say, hey, look, ramp up is going slower than we anticipated. Can we move shipments around? And so far, what we've seen is the utilities, our customers, have been incredibly good to work with. But when it comes to a discussion of breach of contract, it's not even something that's on our minds. We're going to develop those pounds, produce those pounds, and get them to our customers. That's critical for us.
I think they basically have no option but to be good to you, because you're one of the prettiest girls in the room.
Well, thank you, Antonio. But but you're right. It is a very tight market. So if they don't get the pounds from us, where do they go? So no, it's a good observation, but that's certainly not a game we want to play. We want to be a reliable producer. That's one of our top objectives, is to be a reliable provider to the utilities. That way they keep coming back to us in the future years. We sign more contracts and we can develop a strong company. Reputation is incredibly important in this industry. It's a very small industry. And so if you don't provide into your contracts, not a good thing. It can be very destructive to your company.
I do want to talk about utility sentiment, and we're going to get to that possibly in the latter part of the conversation. But when I referenced that you've communicated not having to breach contracts, what you said exactly in that news release is that you expect to satisfy your commitments with production and this is the important part, and I quote, available alternatives. So what does this mean? Does it mean that any of the money that you raise this summer is going to be used for buying uranium in the spot market? Is that the alternative that you were talking about, or is it something else?
I don't want to get too specific on details. We're still working through those, but it doesn't necessarily mean buying pounds. There are other alternative, well-established mechanisms to pick up pounds and deploy to our customers. And we're exploring those, and we're deep into conversations on those. So there are other options besides buying pounds.
Well, and that other part was that you want to satisfy it. Well, ideally, you just satisfy it with production, right? And you've set your guidance to 325 to 475,000 pounds of U3O8 in production this year. What's the probability, maybe in percentage terms, of you actually hitting the that currently set production goal?
Oh yeah, I don't have any new guidance today. That's still our guidance that we've put out, and our objective is to hit that. We'll be coming out with the quarterly report here in the coming weeks. Don't anticipate putting any new guidance out at that time. We'll see. The document's not written yet, but we plan to hit those revised targets.
Well, you just told me that you have, what, 570,000 pounds contracted for this year.
Mhm.
Production guidance 325 to 475. There's a gap. How are you going to feel
Yeah.
it?
Yep. Those alternatives we mentioned.
I'm trying to get that out of you, but I'm not being too successful. But
I'll be mum on that.
no, it's fair enough. In terms of revenue, what's the average sale again? Sale price that you're expecting per pound of yellow cake?
For this year, I think we put out around $60 a pound. I have to look up the precise number, but our contracts this year, recall that they were signed, 2 years ago, when the spot price and the long-term price were more like 55. We were signing contracts in the high 50s and around 60 at that time. So yeah, we're going to average around $60 a pound for deliveries this year. So we got a premium for those contracts because we're a U.S. producer, but our contract book going forward is dramatically higher on the pricing.
So 60 per pound. Now you're going to make me do math off the top of my head. 6 by 5, 3, 30, 42, 34 million, 200,000. Is that your expectation?
Yeah,
for the
we're
revenue
looking at 34 million revenue this year.
Okay.
Yep.
Good. What is that covers your G&A, I suppose. It covers what exactly does it cover?
Yeah, it'll cover G&A. We're not going to be cash flow positive this year. Obviously, we're still ramping up, spending a lot of money on that. And I've talked with you before, Antonio, about economies of scale and how important that is for any mining company. And it's true for us as well. It's incumbent upon us over the coming months to get that flow rate up, to get production up, to capture those pounds so that we can get into those economies of scale. And we need to be doing 500, 600,000 pounds, 700, 800,000 pounds over time to fill contract books and to drive down cost. There are a lot of fixed cost in any type of mining, and we're no different. And so the more we can produce, the cheaper we can do it on a per pound basis. So that's where we're headed right now, is got to get that ramp up continued. We are ramping up. We have been successful this year. Nearly every month of this year, we've increased production. We just need to pick up the pace and have that slope a little bit steeper.
I also want to talk about, or go into talking about, the different alternatives for you getting there, which are obviously exploration, M&A, ramping up, as well as Shirley Basin, right? And some of that money, you've said before, is going to be used for exploration. But how do you balance resources here, be it time, money, or attention, whatever it might be, between looking for more pounds and solving the production ramp up delays, which are kind of the most pressing issues here?
Mm-hmm. Yeah, our priority is production before exploration. So we've got a very long life production at Lost Creek, and as well as at Shirley Basin. So when we're contemplating distribution of funds, distribution of manpower and other resources, the priority there is number one, production at Lost Creek. Number two, production at Shirley Basin, as you mentioned earlier, late next year. Beyond that, growing the resource base is kind of secondary, important, but secondary. And so we're trying to balance between M&A and exploration. One of the things that we always are looking at is it a better use of funds to explore on our existing properties where we have a lot of potential? We've done about 6 exploration programs at Lost Creek over the years since 2005, 2006 time period. Every one of those projects, we've been very successful at bringing in more pounds, and the average discovery cost has been around 50 cents a pound. So if I have an entity comes to me and says, hey, we're willing to sell you a project for $2 or $3 a pound in the ground, I scratch my head and I say, why? I can take 50 cents a pound roughly and find more pounds at Lost Creek, or I can pay $3, $4, $5, $6 a pound for another project. So there's merit in both, obviously. I mean, we need to grow the resource at Lost Creek. We need to continue to replace the pounds we're producing, feed that plant. So that's important. But those are captured pounds. They're there. They're not going to go anywhere, whether we find and discover them, this year or it's 8 years from now, they're there. Those pounds that may be available through M&A, if it's a good project and we don't act on that, those may be off the market and unavailable to us forever, or maybe many decades. It may be not in my lifetime. So we have to balance that. Where do we put the money? Where do we do development? And it's not an easy conversation always. When we talk to investors, I mean, they're looking for something, a lot of them are looking for something exciting, and M&A is exciting. So we get pushed in that direction, even though that may not be the cheapest way to bring pounds into the story. So that's something we have to balance. We look at when we look at M&A, we look at the quality of the project and its synergies. We look at economics, cost of production. And when we do an M&A, when we do a due diligence for M&A, it is a full-blown assessment. We look at everything you can possibly imagine. We bring in our full technical team, legal team, land, regulatory, everybody. We do a full assessment that ends up by being put into a cash flow model where we calculate net present values using appropriate discount rates to determine what we should be bidding on a project. So before we bid on a project, it's a full-blown technical and economic analysis to make that decision. So that's how we do it, and we compare that to cost of exploration. We also look at potential impact to market cap. That's important to our shareholders as well. So all of those things get thrown into the mix before we make any decision.
I think you're doing it wrong, John. What you have to do is just look at the EV to pounds in the ground ratio, because you know what's exciting? You put a big EV to pounds in the ground ratio on your presentation. That's really exciting, it seems, in the uranium market. And I'm joking, but it's sadly true. You just mentioned 50 cents. Is that an actual? Because I wondered how do I measure the efficiency of this exploration program? Is that what you expect, to spend 50 cents for a pound in the ground that you find?
Yeah, I mean, historically, that's what our discovery cost has been. If you add rig cost, geologist cost, supply cost, all of that, it's right around 50 cents a pound. Obviously, as you move forward, it gets more challenging to find new pounds because we find the easy things first. But yeah, hopefully we can keep it under $1 a pound. Maybe, inflation's gone up. Maybe it's 75 cents a pound, but hopefully it's in that spectrum. So yeah, we can find those pounds a lot cheaper. But it's not very sexy compared to going out and doing M&A, is it? If I put out a press release that I found 500,000 pounds versus acquired that through M&A, it's going to be a lot more exciting and probably have a greater impact on market cap if I make an announcement on M&A. But you're right. There are a lot of companies put out a lot of press releases about pounds in the ground and make acquisition of pounds in the ground. And it's exciting. The problem is you pay a lot of money for those, and you may not see revenue from those for many, many years, maybe never, depending on the quality. And what we always say is we're running a business, and we need revenue from those acquisitions. We're not going to just market and go to conferences and talk about the pounds in the ground. What we want to do is go to conferences and talk about revenue and profitability. So it's not that others' model is wrong. It's just a different model. And we're trying to run a real company with real economics.
Well, so 50 cent discovery cost per pound is what you're talking about here. Essentially, what you have to do at the bare minimum is replace the pounds that you're producing. You want to go for 475 this year. Does that mean that you're looking to spend just about $250,000 on exploration, or are you going to go heavier than that?
Yeah, we're looking at exploration next year. We're actually in the throes right now of doing budgeting, but we are considering a fairly significant exploration project next year on Lost Creek and our surrounding properties, and maybe a few others. We've not made any final decisions on that, but we are well cashed up. Very importantly, Antonio, we've got the drill rigs. We've got 17 rigs turning today. I expect 2 more before the end of this month. Probably get up around 20, 21, maybe as many as 22 rigs. But we are now getting ahead on drilling, increasing the space between our construction crew and our drilling crew. So as we go into next year, especially as the weather breaks and we've got good access for exploration. I would love to be able to turn 3 or 4, maybe as many as 5 rigs loose on exploration on existing properties that are within pipeline distance of the Lost Creek plant. Try to continue to replace the pounds we're producing and grow that resource would be our objective. That's a forward-looking statement. I don't know that that will happen, but that certainly would be our objective going forward. Yeah, we've got the geologists, we've got the rigs, got the finance to be able to do that.
But in terms of costing, and you just told me you're budgeting, so you don't have that exact number for me. But if we do a ballpark figure, it is north of $250,000, so more than that, essentially.
Yeah, I would like to be in that range. Yeah.
Okay, good.
Yeah,
is there a lot of
well, I'm sorry. One of the awesome things about in situ and digging wells in Wyoming, in other regions too, is we're digging in soft rock. So for your listeners here that are not accustomed to drilling in sandstone-hosted basins, drilling is very, very inexpensive compared to a hard rock drill hole. Here in Wyoming, we can drill a hole for $4,000, maybe $5,000, get down to maybe 600-700 feet for that cost. If you're drilling in hard rock, you could be easily 5, maybe even 10 times that per drill hole because you're using diamond bits and it's difficult. So for us, exploration is relatively inexpensive. And with roll fronts, you've got the vectoring. When you hit reduced rock, you know that you need to go up gradient. When you hit oxidized rock, you know you need to go down gradient. So drilling is not only inexpensive, but it's also incredibly effective because of the vectoring that the rock gives you. You basically know what direction to go when you drill a hole. So it becomes a game of battleship, but it's quite effective. And a good geologist can put you into mineralized rock pretty quick with not very many drill holes.
That is, I suppose, the main reason why you have that discovery cost of 50 cents, right? I mean, if you were, I don't know, I'm thinking of hard rock, Nevada. If you were in Nevada, let's assume there's uranium there. I don't know if there is, but that discovery cost would probably be much higher than 50 cents.
Yeah, it would be. Different rock types, so drilling is dramatically more expensive in hard rock. And plus, you may get a geochemical signature that may tell you maybe you're 100 yards or a half a mile away, but you don't know what direction to go until you drill additional holes. And that's not the case with us. With one hole, we basically know what direction to go. So it helps reduce cost for making discovery.
And that is only one part, as I mentioned, of your growth strategy. Another part seems to be, again, shifting toward potential M&A here. And I understand you'll be looking for ISR properties in the US. And while there aren't all that many, as you said, if someone wants to use their brain, they might know what asset you might have been going for. But Cameco doesn't seem to be doing much with its ISR assets in the US either. I don't know if they're up for sale because they've not communicated that publicly either. Is there something you can do with those assets? Like, is there an option for you to go and source a deal where there is no for sale sign on those assets, but then eventually you get your hands on them? Is there something you can do kind of proactively, creatively, if you will?
Yeah, no, Antonio, you've hit on a really important subject there, that there are not that many in situ assets or even uranium assets in the US or even globally. There's just not that many. And then when you look at the quality assets, the economic ones that are desirable to us, you reduce that even further. So it's a really small number that we have for consideration on M&A if we want to be economically producing from those deposits. Most of those deposits are held by major companies like Cameco, like Kazatomprom, like Orano. We are fortunate to have a very good project in Lost Creek and also Shirley Basin, but it's just a very small number. And the quality projects, most of the time, the owner wants to keep them and they're not for sale. And at a minimum, they're going to hold it and see where the market goes, and maybe they put them in production in the future. So oftentimes we'll have investors say, "Hey, John, go out and do M&A." He's like, "M&A for what? With what?" There are so few assets out there. Most of them are not of the quality that we're after. A lot of them are going to require much higher prices in the market than we're seeing right now. I could give you a whole list of projects that are probably going to take 100, 120 for break even before profit. And how quickly do we get there? plus profit. So maybe we need a market of 140 for a lot of the projects out there that may be for sale. I'd like to think that's going to be tomorrow that the market gets there, but we've been in the 80s now for a little while. I think we're going to continue to see upward pressure. But, that's a big jump going from 80s to north of 120 to, make some projects economic. So we'll get there, but I think we're a long ways out. And yeah, it's just when you look at the landscape on M&A, it's difficult. Very few opportunities, especially when you're after quality.
Like you said, you're not looking for pounds in the ground, you're looking for pounds in the drums, or something along those lines. I'm probably butchering your quote there. It's a good quote. But essentially what I'm interested in is not revenue per pound. I'm interested in cash flow per pound, because those assets that you're talking about here, 140, there's no cash flow in that. And is there going to be? Well, potentially, but the uranium price doesn't necessarily, as Rick Roll said, the uranium price doesn't necessarily have to go to 140 right now. So what else do you look for? I mean, you say that's essentially what you're looking for: cash flow per pound produced. So cash flow per pound in the drums. That's essentially what you're looking for. But what's that mix made of? I mean, it's part infrastructure, it's part metallurgy, it's part a bunch of things. But what are the main things you look for?
No, the characteristics for a successful in situ project are numerous. You've hit on a few, and you also made a good point there. It's not just revenue; it's profitability on a per pound basis. Not just revenue. Who cares what your revenue is if you're not making money? And so we're looking for that profit. So that's a good clarification on your part. But yeah, it's a complex consideration. The list is way too long to cover here, but a lot of technical, a lot of regulatory, a lot of land. One of the things that we're seeing now as we survey the landscape, again, if I can use that term again, is royalties. We're really happy with our royalties at Lost Creek and at Shirley Basin. They averaged less than 1%. In fact, well under 1%. But when we look at many of our competitors, they have royalties of 5%, 7%, 8%. I've even seen 10% plus royalties on properties. Even if you have a quality project from a technical perspective, but you have to overcome a 10% gross proceeds royalty, wow, that's economically really challenging. So it's not just about technical, it's also about neighborhood. I could name other projects that technically look pretty good and maybe even have good royalties, but they're in a bad neighborhood. You have a lot of local opposition. Permitting is incredibly challenging. Even if you get permitted, operating, over the course of 1 or 2 decades is going to be a constant struggle because of opposition. So yeah, there are a lot of things that roll into decisions on M&A and determination of profitability for a project. So we look at all those things.
What about the timing behind all this, John? And I'm not asking an exact date, of course, but just wondering about the right time in the market or in URG's life to become more active on the M&A front. Like, what do you want to see a certain number on the long-term market, like you said, 140 or something like that? Or do you want to get to a certain threshold of production? Talk to me about these things.
We're always active. We're always looking. A fairly significant portion of my time I spend looking, and our geology team, they spend a good chunk of their time looking. So M&A never goes away. It's always on our mind. So yeah, we just have to evaluate every project as it becomes available in the M&A space. We evaluate it on its own merits and see what we can do. So there are so few opportunities. I hear people ask, and similar to the question you're asking, is when do you jump into M&A? There is no perfect time. When the market is low, say the price of uranium is $20 a pound, which it was not so long ago, typically you're struggling in that time period and you've got no cash to spare. So it's tough to go out and be making acquisition when cash is so precious. Conversely, when the market's hot, the valuations on assets is incredibly high and you're like, wow, am I going to really pay $6 a pound or $8 a pound in the ground for something that's not permitted, has no infrastructure, and maybe has a couple of technical warts? So it's always a difficult conversation. There's no such thing as easy M&A. It just doesn't happen. So we're always looking, always keeping up with news from around the world, but especially in the US, and looking for availability of quality projects that we can bring in. But it's never easy. And I should say too, even when you find an asset you like and you want to acquire, typically the company that holds it, they're very proud of it. And their valuation on that is typically going to be much higher than our valuation. It's tough to come together in the middle to make an acquisition. And that's true for any commodity, not just uranium.
I think that's true for many businesses as a whole, because I obviously don't want to make this seem bigger than it is. And I'm nowhere close to what you're talking about here. But when wife and I were buying our first restaurant business, it was tough to get to a price that we thought made sense on a cash flow basis, because a lot of people are proud of what they've built. It's their baby, or they have the right staff there. They don't want to let go. They like doing it. And so there's a lot more that goes into it than just you submitting a paper and saying like, hey, I want to buy your business. In your case, I want to buy your asset or company or whatever for X amount of dollars. Like there's a bunch of steps in between. So it's a good clarification that you put out there, John. But, and I suppose though, part of the timing is finding, training and retaining the right and the right amount of labor force, right? So it goes back to what I'd asked you earlier. When do you think the labor issues are going to be resolved? But is M&A maybe also a way out of this? Like, are there companies currently operating in a jurisdiction you like that already have the trained staff that you take over together with the company, kind of thing?
That's always a possibility.
Hmm.
But I think, and you talk with a lot of the executives in the uranium space. I think most of them around the world, not just in the US, would say that labor is an issue. And that's certainly true here in the US. So yeah, there may be opportunity out there for M&A to not only pick up property, but to pick up some really good qualified staff. And that's not far from our mind either. When we look at M&A, we're not just looking at properties, we're looking at staff, we're looking at corporate structure. If it is an acquisition of a company, not just assets. So all of those things are on our mind. And we're always looking for really good people that have experience in the uranium space, but they are few and far between. It's been a long time since we've had a booming market. And a lot of them are in their 70s and 80s, and they don't want to work anymore. And I don't blame them. When I'm in my 70s and 80s, I hope I'm sitting on a beach somewhere.
Yeah. Well, you have 30 years to go for that, so you'll be fine. Another growth avenue for you here is, of course, getting Shirley Basin into production. The guideline is currently set at commercial production by late 2025. And we did discuss this a little bit last time, but give me an update here. Is that still the plan? How realistic is it that you'll get there? And what specifically do you have to align in order to deliver this on time?
Yeah, no, it's going really well. We already have our access road has been upgraded this year. We got all of our monitor wells installed. We have the short power line, very short power line that we needed to install. It's installed and is hot. We will not break ground on the satellite plant until spring of next year, but we've got our contractors lined up there. Our long lead items like our ion exchange columns, we ordered those a long time ago. That steel has been rolled, and so the tanks are formed, and they're beginning to work on internals on those. One thing that's given me a lot of heartburn is electrical equipment. We have a substation there, but it's older, so we need to totally upgrade that. And so I've been very concerned that, hey, can we get the parts in a timely manner? And we've got our contract in place now to proceed on that. And very importantly, in that contract, they've let us know that if they can't get it done in time, they've got trailer mounted substations that they'll roll in, and they're big enough to operate the mine off of. So we've got some, that's allowed me to sleep a little bit better at night, knowing that that power supply should be there one way or the other. So yeah, we've got the drill rigs to be able to get things into production. For a long time, there was a shortage of well casing. That has been resolved now. So I think we're headed in the right direction. At this point in time, we are still targeting production late 2025. Once we get construction done, we will have to do what's called a pre-operational inspection, where the regulators come out and make sure you have your procedures, your safety protocol, your people are trained, before they give us the green light. That will likely take 2, 3, 4 weeks to get through that process. But yeah, we are targeting production very late next year, and we're on target for that.
Well, what's the remaining toughest part of the ramp up outside of, again, labor? I mean, I know you'll be doing baseline water quality studies as well, which is kind of a regulatory necessity. But is that a big risk? Is it sourcing acid or is it sourcing pipes? What does keep you up at night?
So right now at Shirley Basin, my guys today, in fact, they're probably leaving about right now to head out there. We're working on aquifer pumping test. And right after that, we'll be testing water quality for baseline. The hydrologic confinement at Shirley Basin is excellent. There have been a number of aquifer pump tests done out there over the years with very, very strong, solid results. So we don't have any concerns with the aquifer pump test, nor do we have any concerns with water quality. We've already gotten our aquifer exemption for the entire project. So that's put to bed. So really, there's nothing that concerns me there. I think the only thing that would concern me is maybe instrumentation, things like pressure gauges, flow meters. It seems like there's still a long lead on those. So we need to be ordering those in the very near future. If the guys haven't already, they may have already. And just contractors, manpower for contractors. That's a bit of a struggle in Wyoming is even if you get a contractor out there to work, they may not have the manpower they need to get things done in a timely manner. So right now, we don't see that as a problem. But I would say if you ask me to guess what could become a challenge, those are the things that could become challenges going forward.
Well, having mentioned water there for a minute, what do you do with water disposal if and when you grow the production here? When you get to a production here and when you grow it, essentially, are you going to have the facilities to deal with it, and are you going to have to get extra permits for wastewater, essentially?
Antonio, that is a wonderful question and should be asked of all mining companies. So Shirley Basin, we're not going to be able to install deep wells for water disposal. That is the typical classical way to get rid of water at an in situ mine, but we don't have the proper formations at depth to be able to do that. We've known that for years. We knew that when we made acquisition of the property back in 2013. So our plan is to install surface evaporation there. We're going to combine that with enhanced reverse osmosis and water treatment and discharge of treated water. The water will be essentially drinking water quality. But yeah, all of that's permitted, signed, sealed, delivered. We don't need any more permits there to be able to install the ponds or for discharge of treated water. It's all done. We're going to use technology we've proven out.
Well, how come? Well, like you almost make it sound like it's easy, but it's not. And the reason why I ask this, like this is within my personal, within my permanent arsenal of questions that I ask because it is a big issue for most mining companies.
Yes.
Why do you make it sound like it's easy?
Yeah, it's not easy. The evaporation ponds, that's easy. You get evaporation, relatively easy to predict year to year what your capacity is on evaporation. The installation of those is technically relatively easy. However, we need to squeeze that water down as much as we possibly can, get as much fresh water out, and just send the brine to the evaporation ponds to evaporate the residual. So the trick is in the water treatment. Reverse osmosis is not new. It's been around for decades. It's pretty well understood, relatively easy to operate. But we're adding an additional layer of reverse osmosis. That becomes more challenging because we're taking that brine and we're trying to squeeze out more and more fresh water. So we are going to push as hard as we can into the boundaries of that technology to squeeze out as much fresh water as we possibly can. Once we've done that, the water is essentially drinking water, but we'll run it through additional systems to collect radium in particular. Before we do any discharge. And that will take it down to effectively a drinking water standard. And we'll discharge it into a surface water, an open pit lake that has actually fairly high uranium concentrations in it. And the water we're going to put in is going to be dramatically cleaner than the water that's there right now. So that's the rub right there, Antonio. And again, it's always an astute question to ask about wastewater management because as you have indicated, for most mines, it's not easy. Water is a very precious resource, and the discharge standards by the EPA, the Nuclear Regulatory Commission, and other agencies are incredibly stringent. And so complying with those, it's not always easy. And we've got the technology. It's been proven at Lost Creek. So it's not new what we're trying to do. We've demonstrated that we can do it. But yeah, we're going to push into that technology as far as we possibly can. And the benefit of that is if you can do that, your cost of wastewater management goes down, and you also conserve more water, which in the arid West is always important.
Your cost per liter, I suppose, or whatever, however you're going to measure per gallon, I suppose, in the US, and it's going to go down, and your permitting efforts and the cost of them is going to go down. What about pre-production capex? I mean, is this more expensive than if you had done it differently?
Yeah, I mean, in a perfect world, what you want is a really deep aquifer, maybe 2 miles deep, 10,000 feet deep. That's a brine aquifer that will accept a lot of water, and you can get a permit from the EPA to inject wastewater into that with minimal treatment, minimal to no treatment. That's a perfect world. A deep well is going to cost, depending on how deep it is going to cost maybe $3.5 million to maybe $6.5 million. Depending on how hard the drilling is and your jurisdiction and some other factors. But they're expensive. But once they're installed, they have a long life, and you have minimal other treatment capital expenditure on the surface. So that's the perfect scenario, the perfect world. Some places we have that, like at Lost Creek, we've got deep wells. But at Shirley Basin, we just simply don't have that option. So yes, the capital expenditure for treatment, when you don't have those deep wells, it does go up. And I don't have any numbers for you, but reverse osmosis systems are not cheap to buy, and there is an operating cost that goes along with it. So that's all factored into our economic analysis that's included in the technical reports for both Lost Creek and for Shirley Basin. And those are linked on our website if anybody would like to do a deep dive into those.
I understand there's no specific numbers that you can give me to kind of compare, but what about the total amount of money? Like, how much money do you have to spend between now and there being yellow cake in the drums at Shirley?
Yeah, so we've been projecting a total of $41 million for that project. That includes capital expenditure and pre-operations development. So, for example, putting in the first few header houses. So we're still looking at $41 million. We've not updated that number for a while. We've already spent several million of that. But next year is where our big spend will be as we build out the processing plant and the evaporation ponds that we were just talking about. So yeah, we're chipping away into that expenditure, but again, the bulk of that will be next year.
Right. And all of this is basically everything we've talked about so far you're doing in order to ramp up production and have more pounds up for sale. Like that's the end goal. As you're naturally expecting an increased demand for US sourced uranium, as you explained to me earlier, how much of that expectation is based on reality and what's happening right now? As in, how's utility demand been? Has anyone else approached you trying to contract more pounds or trying to stimulate you to get there quicker? How's utility demand?
Yeah, it's good. It's strong. We've not really changed dramatically the number of reactors for a while. For a number of years, reactors were shutting down, but the demand for uranium was relatively stable because the reactors that were online, they were becoming more efficient. So they were burning more uranium because they were up and running more. Shorter shutdowns for refueling. They were doing power uprates and other things. So actually the demand for uranium in the US has not changed remarkably. And now we're getting news on reactors that would be kept online. For example, Diablo Canyon out in California. Looks like that one will stay on. It was slated to be shut down. And now we're looking at reactors that have been shut down that they're talking about bringing back online. For example, Palisades in Michigan. So we expect to see in the U.S. Demand for uranium increase a little bit in the coming years because of power uprates, more reactors coming online, and things like that. I'll mention SMRs. They are an important part of the story. And I think we're going to start to see demand for fuel for SMRs not too far out, a couple of years out, because they need to get that fuel. They have to get it processed, enriched, put into the right form to be able to put in the SMRs. Since they're new, that's going to take a little bit longer. They're not conventional. So yeah, we're projecting that a couple of years from now, we're going to be seeing some demand from them. It's not going to start off as a big demand. It'll be just one or two here and there. But we think by the mid 2030s, the demand for fuel for the SMRs is going to be fairly remarkable. So we're looking forward to that. But we're seeing new builds around the world. So let's leave the U.S. behind a little bit, because we don't just sell in the U.S. We sell in Europe. We can sell in Asia as well. And so the demand globally is growing. W&A has pretty amazing projections for year-over-year growth over the next decade, largely driven by new reactors in China, but also a long list of other countries around the world are building out reactors right now. So we expect to see that demand continue to grow. Supply from the mine side is not keeping up, and I don't think it will keep up for a while. I think there's going to be a gap. A number of mines have ramped up. Cameco's done a great job of ramping up their projects in Canada, but beyond that, it's difficult. You've got a lot of old mines that have been shut down for years that people are trying to bring back online. You've also got some new deposits that people are trying to get permitted and built out and bring those online. The threshold to entry into the mining industry for uranium is extremely high. And so I think there are going to be some challenges getting those up and running. I don't want to throw out percentages of what percent of projected production I think will happen, but it's not going to be 100%. In fact, I think it's going to be far below 100% of what projections are right now. The projections you see by companies typically are the most optimistic. They're typically not middle of the road. And so, yeah, I think we can expect to see less production, not more production compared to what companies are projecting. And what that means is that supply is not going to fill that gap for a while. And that's where we come in, ramping up Lost Creek. It's been a successful mine in the recent past. Shirley Basin has a history of in situ mining, and we hope to have that on late this next year. And so we think we're going to be one of the earliest companies in this cycle to be able to ramp up and fill those long-term contracts. And the demand is there, and we expect it to keep growing.
Well, it is the demand part really that I was after here, because I'm trying to gauge utility buyers' sentiment here and trying to understand how rushed they are, if any, or getting rushed by their superiors to go out there and source pounds and have them be, Western, if you want to call it that, Western source pounds. So what can you tell me about the sentiment from the conversations that you've been having?
The fuel buyers with utilities, I think they must go through a charm school where they are taught to hold your cards close to the vest, which is what they should do. So they're very good about not making too many projections there. What I can say is that we do see a steady stream of RFPs coming in from utilities. We respond appropriately with our needs and our ability to produce and consideration of economics. But it's a steady stream. A little quiet over summer, but since summer, we've seen some RFPs come out, and I think we're going to continue to see more, a quicker pace throughout the fall and into winter. That's the normal cycle where it gets slow in the summer, picks up in the fall after the W&A convention conference in London. So haven't seen it pick up a lot. It has picked up a little bit, but I expect it'll continue to pick up going forward.
I don't know if you've watched the House of Cards series. I believe it's on HBO or Netflix. I don't know. I watched it a while back, but there was a little bit, they touched upon the nuclear space a little bit. And where I'm going with this is that there was politics are a big part of the nuclear supply chain as a whole, the entire process. How much of that are you seeing? Like, are there any special insights or anything interesting that you can tell me about the geopolitical, but also just domestic level politics?
Yeah, I think we've not seen a lot of news for a few weeks now on geopolitics and the impact on the uranium space, but we're not at the end of the geopolitics. I mean, yes, the U.S. has put in place a ban on imports of Russian LEU. It doesn't take full effect until January of 28. But I think there's another shoe to drop here with regard to Russia. The sanctions are cutting across the board, not just uranium, but all other sanctions. Russia has been saber rattling about shipping LEU to the West. It is completely within their ability to cut off that supply, and it won't be surprising at all if they do that. Just as a way to play a pawn in the bigger geopolitical game. That's certainly a pawn that they've gotten, and it's the ball is now in their court to make a decision on what they want to do. But beyond that, there are other issues at play here. Trouble getting insurance to be able to ship product. There is a real shortage of ships to be able to haul that material into the U.S. So it's difficult, not just geopolitically, but on other factors as well. It won't surprise me at all if Vladimir Putin makes the decision and tells his guys, play that pawn now, cut off the supply. And so I think that's the other shoe that could potentially drop, and something that we're watching for. I'm not a geopolitician, but it's certainly, I think, very plausible that that would happen. And even beyond that, and more directly important to us, is one of our biggest, or the biggest competitor to us, is Kazatomprom. And I don't want to call it saber rattling, but they have been making some comments in the market about the difficulty of supplying the West because of sanctions, and not on them, but on the impact to them of being able to get material out through Russia. It's not easy. They don't have great alternatives to that. They've also implemented a fairly significant tax that's pretty difficult on the Western JV partners, quite honestly. In fact, Cameco has said that now their production costs in Kazakhstan are pretty similar to their cost of production in Canada. So there are a lot of challenges there. Very notably, too, their executive team seems like it's in a constant state of flux at Kazatomprom. And increasingly, their executive team is more Russia or China leaning, Eastern leaning, not Western leaning. That could be an incredible signal to the market that, watch out, those pounds out of Kazakhstan are likely to go east, not west. So there's a lot to be watching right now in geopolitics. Even though we haven't had much news lately, I think there's still a lot that could happen in the coming year or so that could have a major impact on the market, especially if there's news out of Kazatomprom.
How much of an impact are you thinking about? Because these issues have been there for a while. It doesn't seem like the house of cards has come crashing down yet, but is it going to have the same impact as a house of card crashing down, or is it going to be more of a muted impact?
I'm going to stick with my analogy and talk about pawns. The uranium industry, there's some pawns involved there. It's on the bigger geopolitical chessboard. So I think the politicians in power are playing those pawns piece by piece. Then they wait for a response from their counterparty, and then they respond again. So I don't expect to see a big collapse. What I do expect to see is this continual erosion of Kazakh supply and that relationship with Kazakhstan and with Russia. That's not going to surprise me at all, especially if Kazakhstan continues to move closer and closer to the Russia and Chinese camps, which it appears they are. So I don't expect to see a collapse overnight. I expect an erosion over time.
So no $500 uranium claims here?
Not for me. Do I think it's plausible that there's a significant spike in the spot price that could last weeks or maybe even a few months? Yeah, completely plausible. Do I see long-term pricing? I've got one retail investor that's convinced we're going to go to $300 a pound on the long term, and it's going to stay there and go up from there. I'm not in that camp. That is not realistic. The nuclear utilities could not support that. That would be devastating to them. But can I see spikes well into the hundreds? Yeah, completely plausible. And not a geopolitician. Maybe it's likely. I don't know. We'll just have to see how things play out. But there will be spikes going forward. There have always been spikes in this industry. There are black swan events, positive and negative, things that are just totally unexpected.
John, I've tried to be as annoying as possible to you and ask you all the questions that maybe not everyone is going to ask you. But what am I forgetting to ask you here at the end? What else do you think is important to talk about?
Well, we've covered the waterfront pretty well here, Antonio. Keep watching the geopolitics, keep watching mining companies ramp up, the ability to be able to do that. Watch big data. They're beginning to have an impact on nuclear. It's amazing. I won't bore everybody with the statistics now, but if you haven't been reading about big data and their jump into nuclear power, would encourage you to do that because that is impactful going forward. So, but yeah, that's the news from UR Energy. Ramping up Lost Creek, building out Shirley Basin, looking toward exploration, and always keeping an eye to quality M&A.
Well, that's it from me then, John. Thank you so much for doing this. I've already taken more time than what you had promised me. So hopefully catch up soon in a couple of months' time. Hopefully what you just told me works out well for you. Again, thank you so much for doing this. I'll let you drop off now, though, because I have a very, very, very long trip to make all the way from Wyoming down to Tasmania, which is, by the way, an island off the coast of the southern coast of Australia, and a place I just visited a few months ago to talk to Steve Swatton of CopperCorp. But Steve's back today for an update because they assayed 132 meters of 0.35% copper and 0.2 grams per ton gold, or a 0.5% copper equivalent, that is, if you're about that life. And this was their first drill hole at their Jukes prospect, so that will be the focus of today's conversation. But I'll save you the 10-minute company intro here because Steve and I have had a conversation going back, I think, almost a couple of years now at this point, definitely over a year, I believe. And there's even a CopperCorp specific playlist on the channel where you'll find a lot of a couple of deep dive interviews covering the company in depth. But just briefly, as the name suggests, CopperCorp is an exploration company with a rather large land package down in Taz. The company is listed as CPER on the TSX-V in Canada, where an average of about 320,000 shares trade each day. And I can see a 52-week high of 12 cents and a 52-week low of 4 cents, with a market cap of just about $6 million and 86 million shares outstanding. Today, this is a 7-cent stock. Worth noting, though, last time I checked the financials at the end of August, I believe, they showed me about a $4 million working capital position. It's probably a bit less now, but again, this is just a $6 million market cap company with a rather large cash position. And again, if you want to know more, head over to those previous conversations because, Steve, I'm rushing to talk to you here because that was an interesting news release that you had last week that I kind of want you to help me dissect it here. And it might be a bit early to say with certainty, but what is this thing? Is it still an IOCG? Is there an epithermal system kind of overprinting it? What's really going on down there?
Yeah, it's a good question, and the answer is it is a bit of both. When they look at the Mount Lyell, if you go and look at the research around Mount Lyell, it's very controversial as to what exactly Mount Lyell is because it's got epithermal elements of it. Mount Lyell is the 3 million ton, 3 million ounce poster child that's right next to us. It's now in care and maintenance, going into production maybe by Sibanye, but maybe you heard about the news that happened to Sibanye this week. We'll see how that all plays out. Yep. What we have is a system where we think it's a Candelaria style back arc system, which means to say that it's very low in silica. Now, fundamentally, the difference between a porphyry, if I take it down to the basic level, and I'm going to get shot for this, if you look at a subducting plate and it's going down, at a regular angle, 45 degrees, what you tend to get is you had a plume coming up and it's very silica rich, and silica rich actually intrudes into the surface, explodes into it, porphyry. If the descending plate gets steeper, then you get a more passive system of deeper fluids coming up towards the surface, and then it has a bit of a mixture as it's coming up. It's got IOCG elements, and then towards the top, if the plume gathers some steam and it takes on the upper asthenosphere, then it becomes a porphyry system. So you can have the two, but it is kind of rare. And we have we have a system which we think is Candelaria light, which is kind of the poster child of what we're trying to look for. And yeah, I mean, the elements of both can be a little bit confusing at times when you have one overprinting the other, for sure. And, we go to Mount Lyell and you see epithermal gold area, there's the western side has definitely got an epithermal footprint. And then you see the cerussite alteration, which is very typical of a porphyry. But in the depths of it, which is the Prince Lyell and the West Tharsis ore body, it looks like an IOCG. So there are elements of both. So this is where the challenges for us are actually trying to work out where we are in the system compared to Mount Lyell. And it's been confirmed by the geologist as well at Mount Lyell that he thinks we're in the deeper level. So we're always in the kind of deeper area of an IOCG system. We think it's an IOCG, but they have both the epithermal and the porphyry and the IOCG elements within one ore body. And it stretches for about a kilometer down, a kilometer and a half. Mm-hmm. And of course, we're drilling holes that are 200 meters. So we kind of still struggling around to see where we are in the system. But we think we're below the epithermal system, but within the IOCG.
That's a good point on Mount Lyell, because if I remember our previous conversations, it's got a rather complex geological history with there's multiple episodes of magmatism and tectonic activity that could have faulted and moved around different systems. But could this be a hybrid system where the two are kind of woven together, or is the theory more like there's an epithermal cap on top of the IOCG?
I think it probably is a hybrid system. There are a couple of instances around the world. I think the simple answer to your question is I don't really know, and nobody really does know, and there hasn't been a definitive paper that sort of suggests that this is the answer. But there could be a hybrid system, because we've got to remember these things develop over many, many millions of years, hundreds of thousands, millions of years, and you have a porphyry overprinted by an IOCG. Because so if you imagine that, the subduction gets deeper, and as the fluids are still coming up, and the latest pulse might be an IOCG type system overprinting a porphyry. Yes, it's perfectly possible. And you got to remember these rocks that we're looking at are upper Proterozoic. They're extremely old, 570 million years old. So look, anything can happen. It's mind-boggling when you think how old and how much has happened. There is some evidence that this area of Tasmania has actually come from the North American Shield. Can you believe? I mean, it's impossible it's not actually related to the rocks that are in the rest of Australia. The eastern side of Tasmania is definitely related to Australia, where the western side seems to be related more to North America. So it's come a huge distance, and it's undergone a complex history as it's got here.
It's interesting when you and now we're kind of getting into the details, but when you think about plate tectonics and you look at the how South America split from Africa, where currently they're seeing some similarities in West Africa to the, let's say, the Carajás province in Brazil. Right. Is there a similarity or like a comparison that you could draw between you and something that's happening in Australia?
Look, the type of geology we have is not dissimilar from Olympic Dam, Carapatina, Prominent Hill. I mean, and we're using that as a basis of a model, but the way that was formed was a completely different time area, completely different time zone, and a completely different provenance to what we're looking at. But there are strong similarities in that the exploration style that they're using, or the exploration methodology that they're using, is very similar to ours. What we tend to use is a mixture of gravity and magnetics with some geochemistry at surface. Now, I don't know if you know the history of Olympic Dam, but Olympic Dam was found by really good geology, but it was actually premised on a sedimentary hosted copper deposit type geology. So the first guy that was looking for it in the 1970s, if I'm not mistaken, it was actually recognized as a district of interest in the 50s. And in the 70s, they were looking for, it was Western Mining, they were looking for sedimentary hosted copper. And they intersected this thing that I didn't understand. And they had 1% copper down at 200 plus meters. And they said, well, what's this? But it's got a whole bunch of other elements that shouldn't be with a, sediment hosted copper. So that was the first sort of eureka moment, if you like, that, well, maybe there's something else happening there. So we use that as a model for us. But the closest in analogy that we think, and this is coming from Doug Kerwin, who's an advisor of ours, is Salobo, which is in the Carajás, not Jazz, Carajás area of Brazil. And look, they have 100, their first drill hole, and I have got it here because I was just curious myself. It's 140 meters at 0.45% copper was their first intersection that they had. So you look at our 132 at 0.35 with gold, it's not dissimilar. And yet that's a huge mine. That's huge. More than 500 million tons of material there. But a lot of these things are quite interesting. That, say, for example, Carrapateena, the discovery hole and the first drilling distance from the drilling of the first hole and the discovery hole is 500 meters away. All right. Now, that is in a flat terrain. We've got a hilly terrain where we are. And it's, we're in a different era now where we just can't take a D8 bulldozer and just drive across the mountain and, drill where we want to. It's a different sort of period that we're dealing in. It's a different type of situation where we're trying to find, a similar style of geology, similar style of mineralization, but in a hillier terrain in a socioeconomic environment, which is very geared towards making sure that we have all the permitting, all of the environmental studies, and it takes time, The good thing that we have got a lot of here is we've got a lot of water. So actually, when you get into the drilling situation, you have plenty of water and also a very supportive government here. I don't know if you saw that. I was on TV recently with the local resource minister, which was a real chance thing. I happened to be in Hobart. His secretary calls me up and says, look, we'd like you to appear on, and it was on Channel 9 News here, just talking about the geology. But that's how supportive they are, because we managed to get a grant. The government gave us a grant to help us with the drilling program that we have on right now. So look, at the same time that the BHP and a bunch of other companies were doing exploration in this area, they were discovering these assets in around Olympic Dam. So you can imagine it's one of those situations where, I used to work for BHP and I know how it works. If you suddenly have one area that's having a bit of success, everything gets moved into that area. So this area in the 1970s and 80s was kind of like forgotten about a little bit, because the brevity of activity was going then to the Stuart Shelf and around Olympic Dam and Carrapateena, and to some extent it was also going up to the Cloncurry district. And so it's kind of had a lot of exploration programs done here, but I have a feeling it's because the terrain is a little bit, it's not cooperative sometimes, it's pretty steep. And also there was a lot of activity going on everywhere else, which was a lot easier to do exploration. So it was the difficulty of doing exploration down here, which precluded it from being developed in the same way.
I did see an article on that, by the way. I think you were wearing the same jacket that you're wearing right now, which actually is a good point, because when I saw you wearing a jacket, I was like, we're talking south of Australia. Why are these people wearing jackets? And then I kind of went and looked into it. And one of these days, we're going to do a Tasmania deep dive podcast just for people to kind of better understand the jurisdiction. But the hills that you're talking about, they're essentially kind of like Scotland's hills. They're kind of low mountains, but they keep going. They're kind of rolling over, if you will. And so that is the terrain that you're talking about here, which is surprising because, again, when I'm thinking of Tasmania, I'm thinking of Australia, and I'm not thinking of that kind of vegetation and terrain. Let's zoom in on Duke's on kind of the regional scale, if you will, the regional geology. How well do you think it fits into the broader geological thesis for the region? And more specifically, again, would Duke be kind of a lower grade extension of Mount Lyell, or would it be a copy of it if it works out? Again, forward-looking statements.
Yeah, look, we're definitely not going to have an epithermal gold print that they have at Mount Lyell for sure. What we're looking for is a Prince Lyell Tharsis type body, which is one that extends down to 1.5 kilometers. So it's something very similar to the deeper levels of Mount Lyell. And if you look at the erosion profile, I think it's in figure 5 of the last news release that we had. It gives you a good broad sort of interpretation of how we think it's what's happening there. And we're looking for something that's deeper in the geological profile, and something that may be closer to the underlying intrusives, if you like. Look, we do have 2 other targets which are high priority. Jukes was drilled partly because it's right next to a road, and we could get a drill right onto site, and we know that there's an adit in there where we could drill underneath it. But I'm not saying that it's necessarily the highest priority target we have. It's the one that was most accessible. Hides is a really good one, which is probably a few kilometers south of Jukes. And we've also got another one, Linda, which used to be the lower parts of it used to be the town site for Mount Lyell. And Linda is higher in the geological profile. So you have more chance of getting some of the other levels. And Hides is probably similar to where we are, but there's an incredible magnetic anomaly down there that really needs to be prosecuted. And also in the Hyde zone, we had 23 meters of 0.8% copper, which was taken from a trench zone. It was taken by BHP. They never analyzed for gold, and it's never been revisited as far as we know. I went up there recently to Hides with our geologist, Jono, and we went up to one site where we could see there was an old adit. We took some samples, and there's copper and gold in them, right next to the old track that's up there. Nobody really goes up there. It's not a hunting area. People don't go hiking up there. It's kind of a forestry, thing. And what they do is they put a barrier across the road so people can't go across. We have to go and get a key. So nobody really goes up to these places, and they haven't really been looked at, simply because there's other bigger fish to fry in other parts of the world, other parts of Australia, that have been looked at for the last 40 years, and it's been kind of overlooked. So we've now got this 1,800 square kilometer license area, and look, I can't think that it would go unnoticed from some of the majors that this is a district style thing that we're looking at, and the Razorback itself is right next to a mine that was only closed in 2014. It had 22 different ore bodies in Mount Lyell. It has 22 different ore bodies.
Yep.
So the chances of us intersecting on our first drill program at Jukes, the ore body itself, we'd have to be quite lucky. And I was just before we came online, we talked a little bit about the difficulty you have sometimes with hilly terrains and interpreting geophysics, particularly if the points are far apart. So one of the things we've got to do is we've got to tighten up some of these anomalies that we have with maybe a little bit more detailed geophysics. And of course, with the advent of drones, makes our life a lot easier now than it would have in the old days. Like, I tell you, if you're trekking through the bush here, it's really tough. Really tough. And the costs now are really high because no young people want to go and cut lines through this extremely difficult bush anymore. In the old days, it was easy to find people. Now it's not easy to find it, so it gets really expensive. But with the advent of drones, maybe we're going to have a second crack at this.
I was just wondering how many people live in Tasmania to begin with. It's about 500,000.
500,000. Most of them live in Launceston and Hobart. And on the West Coast, I think we have less than 20,000 people. And everybody in the few towns around here are either directly or indirectly related to mining. Every morning I get woken up at 5 a.m. because it's the shift change for the mine at Renison, the tin mine at Renison.
It's funny, Tasmania is about it's over twice the size of the country I'm in, Belgium. And there's about 12 million people who live here. And it gives you a perspective of how it is. Again, we should do a Tasmania focused conversation. You do talk about, so I'm wondering about this thesis of mineralization manifesting in different ways at different spots of your land package, and you also talk about a magnetic feature at depth there, and possible pipe-like mineralization, if you will. But ISCG systems typically are highly structurally controlled, right? So what's going on with this pipe-like mineralization that you talk about in this news release?
Yeah, what happens tends to happen is the intrusives that come up from, several kilometers down, they come up along the path of least resistance. They come up a fault zone. So often it's regional faults intersected with local faults is where you're looking for. So what we're looking for is northwest faults, with northerly tends to be the general direction in Tasmania. But the northwest faults, we've noticed it's at Mount Lyell and all of these different ones where you got the intersection between the two. And the major fault often leaks to the surface, various indications that you might have mineralization below. But it's coming up from an intrusive, which is somewhere down there. Now, the difficulty is you can model where the magnetics come up, but you're assuming that maybe the magnetics is the source of the mineralization, or is it just the fault itself? You're never really sure. And sometimes it could be a combination of the two. So when we were looking for the pipe-like, when we're drilling for the pipe-like body that's underneath, yeah, we've actually drilled it with the second hole. The first one, we kind of drilled underneath where the adit is, but the second hole has really gone into it. But you might argue we've stopped a little bit short of it, and we're still contemplating whether we're going to drill another 100 meters into the guts of this magnetic anomaly. So the point is look, when you're looking at these things, the intrusives come up faults, and sometimes you just see the expression of the fault at surface, but you know that maybe that intrusive body is the source of the fluids that are causing the mineralization.
Well, that's where I want to take this exactly, is that hole 2, which is going deeper, and you've based it on what you call encouraging visuals or encouraging visual observations, to quote it, from the core. Can you expand on that? What are you seeing in the core? I mean, is it cross-cutting veins? Is there breccias or something else, easily identifiable that you've seen in the core?
Yeah, obviously, without actually putting a news release out on hole 2, obviously we're seeing something that we like in there, and we've wedged it, because what happened was wedging a hole basically means it was going too steep and it was kind of like angling down. So what we've done is put a wedge so we can get across the magnetic anomaly a little bit and a little bit closer to surface. Yeah, the type of mineralization that we see is similar to what we see at the surface. And obviously we're trying to get a good idea of what the profile is, and then we're going to use that information to feed into the geophysics, the geochemistry that we've got for Hides and for Linda and other areas. Yeah, I mean, I really can't say anything more than that, I don't think, because I did have a little look to see what I'd said about that. And look, we won't be drilling holes just for the sake of drilling holes, I can tell you. But once you're in an area, it's cheaper to keep going than it is to come out and go back in again, on a parallel hole or something, twin hole, I should say.
Is it better than what you saw in hole 1?
Well, I can't say that because I don't have the assay results.
When is it coming out? When are the assays coming out?
Well, I can see that a lot of the core here is still not cut, so it's going to be a little bit longer than the first hole. Yeah, I would say probably 2 to 3 weeks before you see the results out from that one.
You're sending them.
Sorry?
You're sending them up to Australia, I suppose.
Well, we're sending them up to Burnie, which is just on the northern shores of Tasmania. There's an ALS lab up there, which has got a fairly good turnaround, but obviously we're fairly small customers of theirs with all the mines that are operating here. So it all depends on if Renison Mine or the Rosebery Mine or Savage River have got a big lot ahead of us. We kind of got to wait, but no. We have put an express order on some of the rocks that we've sent up there, but sometimes the express can be 1 week or 3 weeks. It's really up, it's not in our control.
Is it looking like you'll keep the program at those what did you intended it at 1,300 meters that you had initially thought of doing? Are you going to be expanding it, cutting it short? What are you thinking?
At the moment, I think we'll probably be until I get the results back, I can't really answer that question. I mean, I would love to drill all 1,300 meters if it was worthwhile, but I'm going to be prudent and say Like, if it's not worth us continuing here, I'd rather put it in the back pocket because it's expensive, and maybe go to Hyde's or maybe go to Linda. But it's difficult. I'll tell you why. Because the gold you can't see, obviously. You can see the copper, and a lot of the copper that we have is fairly disseminated, and it's quite difficult for the geologist to estimate the level of copper. So until you cut it, you don't get a really good idea. Even when you've cut it, it's sometimes extremely fine grained, the copper itself as well. So it's not obvious. When you see engine block material, when you see the 3-4% copper, it's obvious. But sometimes the 1% and less is not. And let's face it, I did an SEG talk the other day to a bunch of students in Philippines, and I took some research. I could not believe in the last 20 years how much deeper and how much lower grade the mineralization has got. So even 0.6 is going to be pretty profitable going forward fairly soon. That's what we're at right now. That's the average. The average grade at the moment is 0.3. That the mining head grade, right? And we're getting those sort of values right now. Of course, it makes it a lot easier for me to sell the project if I got higher grade copper. But even if you're getting 0.3, it's still pretty significant. But how much better would it be if I managed to intersect 100 meters at 2% on one of the other ones? I mean, the point is, what I'm trying to say is I'm trying to use the cash that I have, and maybe you're going to talk about that as well, to the best effect. I can always come back. These rocks aren't going away. I can always come back and drill more holes, or if the results are good enough, we'll continue. All I can say is that we got multiple targets on this site, and the time it takes us to get a drill permit is literally weeks, not months. So we can go back in. It's not one of those jurisdictions where you have to wait a long time. Erica Betts is the resource minister here. I met him personally. Extremely supportive of what we're trying to do. Not just us, all of the exploration companies here. So look, it's all I'm trying to do is to portion the funds to the most prospective target, because in North America, as a junior company, you have to have results. In a senior company, and I've worked 13 years for two of the largest, Rio and BHP. Look, they don't really care. You get a budget, and as a geologist, it's like a field day, right? You just go, you can just drill an anomaly just for the sake of it, and it doesn't really matter if you don't really hit. Providing that something at the end of the day, yeah, you will be counted. How much success did you have, Steve? But you're given maybe 10 holes in an area to go and drill, and if you have success, great, and if you don't, well, nobody's going to chastise you for it. Whereas in our business, if you don't have success in the first 2 or 3 holes, which is extremely unusual, people start selling you down, going, "Oh, look at these guys, they don't know what they're doing." But it's not as easy as you think it is. Well, I think a lot of people realize how difficult it is, but it's not that easy to hit on your first holes. You have to it's like anything in life, you have to get your bearings a little bit. Okay, this is what the geophysics is telling us. All right, so that huge magnetic anomaly is really just magnetite. Okay, so it's coming up faults then. So you've got to get your bearings in as to what you're looking at. But what we know is there's a huge amount of smoke on this Razorback property, which has never been tested before. And that's the point. And maybe we do need a big guy to come in and help us a little bit. And look, I've already said this before. I am talking to major companies as well. This is something that would appeal to them. And if you look at some of the deals that have been done in the past, it could be, an option for us to go down that route as well.
Well, has anyone curious, anyone interesting call you after the announcement or
yes.
Start looking at? Oh, okay. So people are paying attention.
I did get one call from one group immediately afterwards. And I'm going to be meeting with them in the conference in IMARC, which is next week, the end of this week. Sorry.
And that's something you're actively going to keep pursuing under the right conditions, I suppose. A JV. What does that look like? What's the type of structure you want to go for? I mean, is it? And I think we might have touched upon this last time as well. But what kind of structure is interesting to you here? Do you want to give away 50% of the asset? Like, what would it look like?
I say if you go and look at the deal that Inflection did, I don't know if that's one of your clients, Inflection, with Anglo Gold Ashanti. I think that's a really good model. They basically, the company have to choose several targets, do a bunch of drilling to earn increment, as they're going forward, they have to actually take parts of the asset. They take a percentage of it, but they relinquish it if they're not actually doing any work on it. They have to spend at least, I think it was 7 million for that one, and it's a good model where they haven't got a blanket approach saying, okay, we can get 30% on anything within the whole gambit of different targets that we have. You've got to choose a few targets. And then if you're not going to work on it, it kind of falls back 100% back to the company. That's the type of one. But yeah, eventually these companies have the right to earn into 70%. That's what I don't know. Look, having worked on the majors side, no major wants to be a 50% shareholder with a junior company. It doesn't really work like that. So, they have to spend a fair amount of money per target in order to get a majority percentage ownership in that particular target, and the targets are defined. So that's the type of deal that I think would work for us. Incremental is the word I was looking for.
That's going to be the main thing I'll be on the lookout for. I just want to go back to the drill program here, though, for a second, Steve. How's that been going so far from an efficiency standpoint? Are you coming in and on budget?
Yeah, much better than the Darwin one. The Darwin one was tough because the rocks were much harder. And this has gone pretty well. I mean, if you're drilling into volcanics and the volcanics are pretty regular, the guys, it's like any drilling project. They have to be a bit careful going through some of the faults, but it's been fast. And also logistically, it really is. It's not even 20 meters off a secondary road here, paved road. So it's very easy for them to get to site, get on site. The rocks are pretty soft, and also we've had a lot of rain, so there's no problems with water. I mean, one of the problems in other parts of Australia is they have to basically truck in water for the drill programs, but we don't have to do it. So yes, it's been going a lot quicker. No problems, and on budget. Yeah, definitely on budget.
So how much more? What is a meter of drilling and assays costing you altogether?
Well, without the assays at the moment, it's about $225 per meter. We've done some work on it, which is in line with most North American. If you're going to do RC drilling and other forms of drilling, you're going to get a lot less, but that seems to be about the norm. And obviously, depending on the type of analytical processing that you want, you're going to put another $100 on that. So look, it's not cheap, but it's not right up there with expensive. It's somewhere in the middle.
Are you going to make me do math off the top of my head, or can you tell me how much cash you have left?
We have 3.4.
Okay, so still, well, I actually thought it would be less than that.
No, we have 3.4, and we haven't actually spent a lot of the stuff that we sent down to Australia. They've still got quite a lot. So it's probably a little bit more than that, but that's what I'm saying we have, because that's what I see in the account in Canada.
Okay. So something else in this news release that's kind of that we didn't talk about, and there wasn't all that much about it actually in the news release, but rare earths, right? You mentioned REE potential, but again, not much detail about rare earths in this release. So where's that coming from? What does it mean? Talk to me about that.
Well, I think it goes back to our original question that you asked me about, the hybrid type nature of the mineralization that we have and everything else. There are rare earths, as we know it, tend to occur in the deeper levels of an IOCG system. So the further up you get now, in the deepest levels of Mount Lyell, there are rare earth elements, but there's none at the surface and in the midsection. And if you look at the profile, I think Darwin was towards the bottom of the profile. And as you get higher up, you don't get so much. We don't get any in Dukes. In height, it might be, but we're not really quite sure where we are in the profile. So the simple answer to your question is that we think we're too high in the system. If we drilled another kilometer and a half, we may well find it. We may well find them.
So how confident would you say, maybe on a scale of 1 to 10, how confident are you that you understand the system and know how to plan your future exploration from here on out, and spending that 3.4 million? Because that's going to be really more important than the sheer size of the cash position.
Look, I think we're getting, compared to 2 years ago when we started on this journey, and even 6 months ago, I think we're really honing in on the system that we're looking at. If the challenge that we have is that using geophysics, geochemistry, and geophysics is the interplay between magnetics and gravity and the surface faulting, it is actually to detect whether the magnetic target that we're drilling is necessarily the source of the fluids that are bringing in the mineralization. So it's not the geological model that we're uncertain about. We're pretty certain there is a profile, and we're sitting sort of mid to lower within the system, which is the lower end of Mount Lyell. It's more to do with trying to direct the exploration program. When you think about, 500 meters was the distance between the discovery and the first hole at Carapatina. 500 meters, a lot of drilling would go in there, and a lot of budget would go in to find that. It's trying to hone in on what's the best magnetic gravity response, bearing in mind that not necessarily the center of the magnetic anomaly is what you're looking for. It could be the edge of it, which is what they found in Olympic Dam, and what they found at a lot of these Stuart Shelf, Gorlick Raton type. It's not necessarily the center of the anomaly. It's on the edge of it. So which edge? I mean, how much drilling are we going to do to find the edges of these things? So yeah, we understand the system. It's just like, where do we direct it? So what we're doing at the moment, if there's a fault and we have surface mineralization and we have an interplay between the gravity and the magnetics, that's the location where we drill. But every drill hole is an experiment, and it's also a learning experience. Okay, no, maybe we need to go a little bit west or a little bit east. Now, as a junior, you're only given so much money, and people get tired and say, "Oh, these guys, they have no idea what they're doing." Not necessarily with us, but with others. But the problem is with these ones is it's not like a porphyry where you have nice concentric zones of, okay, we've got the outer, prophylitic zone, and then you go in and you find the ore body. No, we don't have this sort of veining, stockwork veining that they have, or anything like that. We just have subtle signs. It's an interplay between the geophysics and subtle geochemistry. It's not obvious, and we got this terrain correction that we need to do for every different geophysical model that we do. So it's not easy. So yeah, long answer to your short question is I think we do understand the geology, but we don't understand sometimes exactly where the best spot is to drill. But we're getting more information the more we drill at Dukes.
You're making it sound like copper porphyry exploration is easy, though.
It's a lot easier.
It is easier. Not easy, though. I wish it was easy. I think my portfolio would have been doing
not.
better.
It's just that it's more recognized. It's more, as a geologist, like I'm as old as the hills here. I studied at university, but IOCGs weren't even a thing when I was at university. So it's a new science, and people are still learning more and more about it. We're having, just in the last 5-10 years, they're learning a lot more than they knew before. But yeah, it wasn't even a topic when I went to university because they didn't know what they were. If you think, BHP, Western Mining had the discovery of Olympic Dam, which is the largest uranium uranium deposit in the world, and the fourth largest copper. It took them like 5-10 years to realize what it is they were looking at. And I graduated in 83. So we didn't know anything about these types of deposit. We heard about them, but we didn't know anything about them.
Yeah, exactly. That's it. But that also makes it interesting for me, because it offers, oftentimes it could offer opportunities at this stage, because it's just so easy to kind of write it off maybe at this stage and be like, oh, too complicated, I don't get it, just leave it alone. But then sometimes these things surprise to the upside, right? I mean, it could be the next hole that you drill that gives you all these answers, or the next 3-4 holes that you drill. So that's really what makes IOCGs and intrusive related deposits interesting to me. What you said 2 weeks from now is when you want to have the assays from hole 2. Are you going to release assays kind of on a one-off basis, or do you want to batch them? How are you going to be putting assays out?
I think we're going to batch this one simply because we're also doing the wedge, and we can see some zones which are, I'd rather just do it in one go and then give a kind of a thesis as to what we're going to do next, like in that news release. Like, the problem is that I find is that when you drill one hole, if you don't have huge success in it, everybody gets all disappointed. And I would argue, 130 meters, 0.35 is a success, but you'd be surprised how many texts I got saying, no, I'm sorry about the results. Like, well, hang on a minute here. So I've realized that, through experience here, it's sometimes better just to batch them up and at the end and say, hey, but this means that, this is what we're going to do with these results. We're going to go and move the rig to this point or that point, but we can't really do it on the fly until we got the results of the whole program that we're running at the time.
So essentially, no point in me asking you what comes after that, because it's assays and then base the exploration program based on the assays.
Certainly, you can ask me that, because I certainly know that we're going to do a lot more boots on the ground geology in this part. We can get around. Jono and I were up this is the geologist, we're up a couple of other locations that we have, and it's all accessible by ATV. So we're going to put more geologists on the ground. And then there's drilling seasons for Tasmania, because of the water situation, tends to be either side of their summer. So even though it looks like this is the big start of the summer, I'm still wearing a jacket. The water is the determinator of how expensive your drilling's going to be here, because if you start shipping in water, it gets extremely expensive. So you tend to do it in the shoulder season, so in the spring and the autumn. And now we're coming into the summer, so for the next couple of months, it wouldn't be a great time to drill. But if we have a water source local, we'll do it. We'll look at every option available, but all I can say is we're going to be ramping up the amount of people that are in the field during the summer.
What about in terms of marketing? You're reminding me of summer in Tasmania, winter over here, which means that tax loss season is coming along. Your stock is down on the year, not as much as some others, but it is still down on the year. So what are you going to do in marketing in terms of marketing in an effort to maybe try and mop that additional supply of shares that might come online during tax loss season?
Yeah, I'm off to Europe after Australia here. I'm doing a little one-on-one roadshow, taken around by an individual to various different cities in Europe, and going to go and get the story out to a wider audience, and maybe get more into European hands and less into sort of the fickle North American fingers.
So who are you marketing to? Do you have a target audience in mind, or who's your ideal investor?
Family offices, small funds. There's plenty of them in Europe, and some of them are extremely, cash rich at the moment and looking for opportunities like this. I'm going to Zurich, Munich, Frankfurt, and Stockholm on this next trip.
Good. Well, it seems like we're going to have loads to talk about shortly here. But again, we should also do that Tasmania deep dive. I think it's an interesting jurisdiction and an underlooked one. But I think I'm out of questions for now. I'm getting an idea of where this is going. So thank you for the overview, Steve. What am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
No, I think we covered everything. I thought you'd ask about the last news release. I mean, as far as I'm concerned, I think it's extremely good news when I look at Salobo 140 meters at 0.45% copper. That was their initial aha moment. We got something fairly similar. So I think you covered it, and I managed to express my interest in the results we got so far. No, I think we covered.
Awesome. Well, thank you so much for doing this, and hopefully speak soon.
Thanks, Antonio.